Trading and fronting Lacroix in London with Tom McKenzie.
And here are your top stories. Fed Chair Jerome Powell says rates will climb higher and stay there longer than markets anticipated after the FOMC hikes by ½ point. Wall Street drops, Asian stocks follow European futures in the red. Next up, Bailey and Lagarde. Policy decisions are front and centre in Europe, with the BOE and ECB seen following the Fed with 50 basis point rate hikes. Plus, documents show FTX executives may have used computer code to mask Alameda's research's ballooning debt pile.
Now, Tom, let's also take a look at the futures. This is across the board. A bit of pressure after we heard from Jay Powell saying there's still ways to go until they're reining inflation. And so we're seeing pressure with the DAX futures, for example, down 0.8%.
Will the markets finally wake up to the message from the Fed? Fighting the Fed, arguably, is what investors and markets have continued to do. Yes, we're seeing the sell-off, but in terms of the terminal rate and the dot plots, forecasting now 5.1%. That is the top plot for the Fed final rate in 2023. Still at odds with what the markets are pricing. To what degree will that adjust in the days and weeks ahead? Of course, today, ECB, BOE, currently the FTSE 100 down 0.3%. Again, expectations of 50 basis points, but there's division within the MBC at the BOE. We'll break that story down for you, of course, throughout the hour. The CAC current over in France, despite the victories of the French team, currently down 0.8% over in France. The Spanish IBEX down 33 points. The ECB, again, expecting a move in terms of 50 basis points higher for the ECB. The BOE 50 basis points, that's its expectation. ECB 50 basis points. But the focus really when it comes to the European Central Bank is the programme around quantitative tightening, which could kick in next year. Let's switch it over to see how things are playing out cross-asset then. After the losses of around 0.7% yesterday stateside, futures now looking to build on those losses, 0.5%. You were back below 3,000, the S&P. Futures currently just holding on to 4,000 as the level. Euro dollar 106, pressure on the single currency, down 0.4%. The pound 123, stronger dollar is back in play, a loss of 0.4% for sterling in the session today. And the benchmark stateside 348 for the benchmark. Not a lot of movement in terms of yields, but you did see a tick up yesterday, again on the back of the more hawkish commentary from Fed Chair Jay Powell.
So, Tom, the Bank of England likely to slow the pace of interest rate rises as it balances risks from high inflation with concerns that overly aggressive action might unnecessarily deepen the recession ahead. So let's get straight to our UK correspondent, Lizzie Burden. Lizzie, investors and economists, of course, expecting a ½ point hike. What else are we looking for today?
Well, Francine, what I'm really interested in today will be the vote split, because Bank of America, JP Morgan, Nomura have all pointed to the possibility of a four-way split, and that would be the first in the Bank of England's independent history. 75, 50, 25 and no hike at all. And the reason is, on the one hand, you've got inflation still in double digits, proving stubbornly, persistently high. But on the other hand, you've got doves on the committee who are very worried about the 18-month lag in monetary policy, meaning that an aggressive hike now wouldn't take effect until the eye of a recession later. The other thing that I'm looking out for today is the guidance, because you remember at the last meeting, the bank really pushed back hard against the market curve, the future path for rates. They said, though, that they didn't want to provide a running commentary on the curve, that was a one-off. But if they don't talk about the curve, could look like an endorsement. So they're going to have to tread very carefully today.
Is monetary policy from the BOE even working? Yes, inflation has edged down a little bit around the margins in terms of the UK print on CPI, Lizzie. But are there question marks about the effectiveness of this policy from the BOE?
I mean, everybody's asking it, and it's certainly a question that's surrounding the Governor Andrew Bailey at the moment because this cost of living crisis is proving so persistent. But interestingly, there was a survey by the bank itself which found that almost as many people want to see a rate hike to boost their pandemic savings as want to see a rate cut to reduce their debt servicing costs. So really, the monetary transmission mechanism is fundamentally different to when the bank was made independent. And lots of people, more people than historically, have got fixed rate mortgages now, so they're less affected by these incremental moves. But I have to say, for all those people who locked in fixed rate deals at rock bottom rates during the pandemic, if they were on a 2-year and they're waking up to a 14-year high interest rate today, they're in for a nasty surprise.
Lizzie, how does this actually impact not only sterling, but some of the gilt sales that we could see into next year?
Well, first of all, on the pound, if we get a 50 basis point hike as expected, it's really pretty much priced in, so won't have too much of an effect. But what sterling will be more affected by is the outlook into next year. And I've been speaking to economists who say really it's all about Brexit into 2023, whether we get certainty, pragmatism, especially on Northern Ireland, that should be impacting the story on sterling next year. As for QT, I would just say they're not really going to announce much today. Chief Economist Hugh Pill has already said that they want it to be running in the background with interest rates the active tool, so the focus very much on the rate decision.
Lizzie, thank you so much. Lizzie Burden there on the Bank of England. Now, there are about 5 decisions today, including the ECB, which is just as important, especially when it comes to rolling down QT. Now, we have the Philippines, Switzerland, Taiwan, Norway, BOE, and ECB. So this time is what we're expecting on the ECB. I don't know whether we have charts. It'd be great if we had charts on the European Central Bank. Also to have a look at what that means for euro dollar. Maybe we look at some of the underlying concerns, of course, on inflation. Now, the ECB decision guide, of course, is what they'll do with QT. Poised to slow the recent pace of interest rate increases, but also today we're expecting an outline to shrink its almost 5 trillion euros of stash of bonds, broadening efforts, therefore, to curb some of the inflation that's still 5 times their target.
And the challenges around the periphery, and we were speaking to Maria today about this, she says that actually the risk premium has come off BTPs over in Italy a little bit because of restored confidence, at least for now, around the leadership. Of course, there have been concerns that the new Prime Minister over in Italy may not follow the rules, of course, being set by Brussels. Those concerns, she was arguing, have arguably come off a bit. You're seeing BTPs 388 on the 10-year, 274 on the 2-year in Italy. So there's a move higher of 8-9 basis points at the front end. But there has been, in terms of the spreads between Italian BTPs and German bunds, that's come in a bit, which has eased. There's some market calm. And to what extent does that continue?
Right. I mean, for a long time, of course, you have the tools from the ECB because they've been buying so much, which is why you're not really seeing that rate differential between bunds and BTPs. What was also interesting, I think, in the last couple of weeks was, for example, ultra-hawkish central bank governors. For example, Mr. Nagel of Germany also saying that it's time now to temper some of the pace increases because of the upending recession.
So an interesting shift there from the hawks within the ECB. Talking of hawks, of course, we did hear from Jay Powell, and yes, they moved down from 75 basis points to 50 basis points, as widely expected. But it was the commentary, the insistence that the fight has not been won yet against inflation and that rates will be kept higher for longer, pushing back on markets' expectations, possibly of a cut in 2023. Again, the dot plot's going from 4.6% on the terminal rate to 5.1%. We had some reaction from Bloomberg guests to what we heard from Jay Powell and that decision of the FOMC. Take a listen.
His forecast now is for GDP to be lowered to 0.5 for next year.
If anything, 0.5% is probably overly optimistic.
It is quite a hawkish tone from the Fed, more hawkish than the markets had been expecting.
What that tells you is he's not forecasting recession, but that's as close to a recession as they ever get.
They have to slow the economy down sufficiently to generate enough slack in the labor market so wage trends come down to be consistent with 2% inflation.
We've had a kind of a back and forth and a little bit of debate of, whether we've seen the bottom in equity markets. I think the jury is still out, and I think a more cautious stance is still warranted.
The key components are still quite sticky, and that would suggest more tightening is needed.
Bloomberg TV guest there, of course, commenting, reacting on the back of that Fed decision. Just checking in your markets then, you're seeing losses now of 0.9% across European benchmark equities. Of course, investors now moving from the Fed, looking ahead to the ECB decision later today. Futures in the US down between 0.5 on the S&P E-minis and 0.8% in terms of the drop on the NASDAQ futures. Just checking euro dollar, 106. That is a drop of 0.4%. Will that change on the back of what we hear from Madame Lagarde over at the ECB later today? Now, just teasing a big interview for us on this show and the importance of the auto sector. We're going to be speaking to Volkswagen's CFO, Arno Antlitz, about what the next year has in store for the German car maker. Stay with us for that interview. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Farrell. Weekdays on Bloomberg. It's the ECB's last rate decision of the year. Bloomberg has you covered with breaking news from Frankfurt and Christine Lagarde's following press conference. Coverage starts today on Bloomberg, your global business authority.
The full effects of our rapid tightening so far are yet to be felt. Today, the FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate. Inflation remains well above our longer run goal of 2%. Changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. And I think we're getting close to that level of sufficiently restrictive. With today's action, we have raised interest rates by 4.25 percentage points this year. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way.
Well, that was the Fed Chair, Jay Powell, at the FOMC press conference after that 50 basis point hike. The dot plot revised up to 2023 projected a peak rate at 5.1%. I have to say it was very hard. You either had to watch the football match or follow the FOMC decision. That was a life choice.
Yeah, they could have set the timing a bit better, couldn't they? Take into account France versus Morocco. Yes, so pushing back on the rate cut idea, of course, from these markets, fighting the Fed still, arguably 5.1% on the terminal rate at this point, of course, as we digest, of course, the news out of the Fed and that decision yesterday and look ahead to ECB and BOE. Who better then to be joined by Yari Stern, Chief European Economist at Goldman Sachs. Yeah, we will get your views on the Fed, but we want to throw it ahead to the ECB and the BOE. Let's start with the ECB then. Francine was talking about the fact that, of course, they're revisiting, or at least they're going to be giving an update on quantitative tightening. Arguably, that's more important than the rate decision today. Would you agree with that? And what are you looking for in terms of the details around those QT plans into 2023?
Yeah, I think that's probably right. The Governing Council is widely expected to step down to 50, follow the Fed. So I think the focus really will be on the quantitative tightening plans. I think base case here is that they will lay out the broad principles. They will say we want to unwind the APP holdings, we want to do it gradually, but the policy rate is still the primary tool. So things that are more about the broad principle rather than the specifics. And then probably say that a decision on the calibration and the timing will come soon, but we're probably not going to get all of those details on the QT front today.
Yeah, I mean, it's a pretty exciting week. First of all, 11 central banks, I think about 5 today. I mean, this is like what you call a good December 15th. What are you most excited about? So is there, I don't know whether the BOE is more interesting because of what we heard from the Fed, so they could have a similar pattern saying, you know, we're more aggressive longer term, but cool it off for now.
Yeah, I think the most interesting is going to be how the central banks combine the message of slowing down, because we've already done a number of hikes. We are going into more economic weakness in terms of growth. There's some green shoots on the inflation side that allow them to slow down, but at the same time signal that the job isn't done yet. The Fed obviously did that yesterday through the dots along the peak projections. But of course, the European central banks don't have dots to the same extent. And so I think that will be key today to see how does the ECB say that the job isn't done yet. They will probably do that through the inflation projections that are going to go up a little bit again. And then I think the Bank of England will probably continue to say more tightening is needed. We will act forcefully if we have to. But I think managing that slowdown whilst also signaling that the job isn't done yet. I think, to me, that's the most interesting today.
The debate within the BOE, or the debate between the markets and the BOE, is slightly different to the one shaping up between the Fed and the markets. The markets are betting on more hikes from the BOE than maybe some officials within the Bank of England are expecting themselves. Do we get to a kind of 5% level in terms of the top rate from the Bank of England, or does the heavy lifting actually come from the slowdown that we're seeing across the economy here?
Yeah, I think that's right, that the Bank of England is more split. There are more cross currents. You are seeing an economy that's a lot weaker than the US economy, of course. We think we're already in recession. At the same time, the wage numbers are still very strong. So the private sector wage numbers actually went up rather than down in the latest report. And so I think it's natural that there is going to be a bigger range of views. Our own view is that they slow down to 50 today, but they're not yet done. We think they will do another 50 in February and then go to 4.5%. So I think it's a message where you say, yes, we can slow down, but there's still more to do, and we will go to a higher level.
They stop at 4.5?
That's our forecast, yes.
Yari, how much of a nightmare is it being a central bank? I feel like I ask this every week or every month or every year and every time, but I feel like this is really, I mean, they could really mess this up.
Well, it's very tricky because you have, particularly in Europe, the situation where you have weak growth and high inflation, which forces you into that trade-off. So in a way, the Fed's job is easier because it's a situation of excess demand. It's about slowing growth below potential, about rebalancing the labor market. But it's sort of a known issue of how to do that. There's a risk that you over-tighten, but it's kind of pretty familiar ground. I think the issue in Europe is that it's predominantly a supply shock, which pushes down growth, pushes up inflation, and that makes it much harder to do that trade-off. I think until now, the central banks have gone very quickly. You kind of really had to lean against the surge in inflation. But now I think you come to the point where you have tightened quite a lot. there are some green shoots on inflation starting to cool off a little bit, and I think that's a natural point for them to slow down.
Has the ECB, has it covered its bases when it comes to peripheral risk? There's been relatively calm in the markets. Does that hold up into next year?
I think there's been quite a bit of progress with these different anti-fragmentation tools that they have, the PEP reinvestment flexibility, the TPI, of course, OMT is also there. So I think they have a lot more in terms of toolkit than in the past. And of course, as you say, markets have been quite calm on that front. Nonetheless, I think there's still some risks on the sovereign side as we go into next year. Growth is slowing, rates are higher, there's a lot of issuance coming in the first quarter, and so we do think that there's going to be a bit more upward pressure, both on core yields, but also on peripheral spreads as we go into next year.
Yari, thanks so much. Yari Stender, Chief European Economist at Goldman Sachs. Now, coming up, we'll get corporates. We'll be speaking with the Volkswagen Chief Financial Officer, he's Arno Antlitz, about what the next year has in store for the German car maker. That's coming up shortly, and this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
Welcome back to the Open, everyone. 21 minutes into European trading day. A lot of the pressures on the back of what we heard from the Fed yesterday and the dot plot. You can see European stocks down 1.1%. A lot of these equities are falling, of course, ahead of interest rate decisions here in the UK, but also from Frankfurt, the ECB, and actually this is after the Federal Reserve indicated in broad terms that it would hike rates higher than anticipated next year, and that's really put a dampener on things. The picture overall, for example, dollar, it's climbing, yuan also falling as we had some poor Chinese economic data.
Yeah, the data out of China was really grim, particularly around retail sales. A drop there of almost 6%. Industrial production also missing. Fixed asset investment coming in lower as well. This was data prior to the reopening and the move away from COVID zero, but the issues in China persist as infection rates soar. So it is a reminder of just how much work is going to have to be done by policymakers to shore up that economy. As, of course, we weigh up the inflation impact of a reopened China into 2023. Across these markets, then, Just across the benchmark, you're seeing now losses of 1.2%. On a sector-by-sector basis, it's consumer products that are leading these losses, down 2%. Retail price goods as well, currently down 1.9%. At the top of the list, but still in the red by 0.3%, is telecoms. Autos also low by 0.4%. So that's on a kind of sector-by-sector basis. The futures in the US, S&P E-mini is down by 0.9%, but the NASDAQ futures now off by 1.2%. Again, investors continue to digest the message from Jay Powell. Do not fight this Fed. We will hold higher for longer. The dot plot's being moved to 5.1%. And a refocus, of course, as we preview the BOE and the ECB. 50 basis points expected from both in terms of hikes. But when it comes to ECB, it's really about the language, as we were discussing with Yari Sten there from Goldman Sachs, around quantitative tightening. The Bank of England is facing a conundrum as well in terms of the divisions that you might see coming through for the MPC and the Bank of England. Let's get into the auto sector, though, and one particular company, the standout, of course, in terms of the largest car maker globally. 2022, it's been a year of big highs. It's also been a year of arguably lows for Volkswagen. The CEO, Herbert Diess, was ousted and replaced by Oliver Blume. Meanwhile, Porsche shares have gained about 25% since their trading debut in September, making the manufacturer of luxury sports cars one of the best performing IPOs in Europe this year, of course, within a challenging environment. The Volkswagen CEO is reportedly expected to present his new software strategy today. That is important. We're joined now by Volkswagen CFO Arno Antlitz. Arno, thank you very much for joining us. As we look back briefly on this year, the success of the Porsche IPO, the executive changes that we just outlined there, and look into 2023 with all the concerns about recession, energy, how is 2023 shaping out for Volkswagen?
Yeah, hello, Tom. Good to talk to you. Let me briefly talk to 2022, and then I move on to 2023. 2022 was obviously a challenging year. We saw the war in Ukraine. We have COVID measures in China, still undersupply of semiconductors, and still we proved quite robust. We showed rather robust results, and that gives us confidence for 2023. From our perspective, 2023 might be even more challenging than 2022. We see the economy weakening. We see interest rates going up. We see inflation. And on the other hand, we expect a better supply of semiconductors. The industry will still be undersupplied with semi, but a better supply, and that will move the whole industry in terms of offer. So the combination of headwind in terms of cost, and on the other hand, a better supply and therefore increased competition will make it a challenging year, 2023.
Yeah.
On the other hand,
Mr. Antlitz,
we are very well positioned. We have a very convincing strategy.
Yeah.
We are continues to transform ourselves, and last but not least, we sit on a huge order bank of almost 2 million cars in Europe alone, and this order bank will carry us way into 2023. So we are quite optimistic talking about 2023.
Yeah, talk to me about inflation in 2023 and how that will hit actually demand for your cars, and also, are you able to pass on some of these increased costs?
As said before, we expect 2023 to be challenging, but still we expect a small growth in the industry. Not surely double digit, but a small growth that will help because the whole industry was undersupplied with semi in 2022. On the other hand, as you said, we expect this inflation and the increased competition. So it will be more difficult to pass on some of the headwinds in terms of prices, and we will see, from our perspective, a combination of passing on these headwinds in terms of price, but we have to increase our work on the cost side, work on fixed costs, work on productivity in order to compensate for some of these effects.
Okay, so just on that point in terms of sales growth, can I be clear? You expect single-digit sales growth in 2023, just briefly on that?
Yes. We expect single-digit sales growth, basically from a demand side, but also we sit on a huge order bank of, as said, almost 2 million cars in Europe alone, and that will help us really way into 2023.
Okay, Arno, just briefly on the software question, because you speak to ID4 owners, I ride into them in work sometimes. They love the car. A lot of people challenged by the software. You know this. What are you doing? Where are you in terms of the company at VW, you and the team, in addressing those software issues?
Look, software is an integrated part of our strategy, and we really work on advances on the software side. The ID3, ID4 software, we call it 1.1, made huge progress already, and it's improved version by version. We have a clear focus on that topic, and we really make that, it's still an integral part of our strategy, and we also will progress on the software side as well.
Talk to us, Mr. Antlitz, a little bit about all of the speculation about what you're IPOing next. Will it be, I mean, is it the high-end brands? Is it a Lamborghini? Is it the battery space?
Yeah, you said before we saw very well a very successful IPO of the Porsche, but as we always said, we really focus, if we do a next step, more on the horizontal side, more on the platform side. We embarked on a strategy to ramp up our own software business, and we embarked on a strategy to ramp up our own battery business. And specifically, the battery business needs a lot of upfront investment, both for the factories and for the upstream, basically for the upstream value chain. And if you think of a potential next, like financing from with external partners, either a strategic partner or IPO, that might be the next field we look at.
Arno, just briefly then, in terms of the debt markets, as we look at higher rates and ahead to the ECB, how challenging do you expect the debt markets to be for VW in the years ahead?
Look, we have very robust results. We have a very robust balance sheet. We have a huge net cash flow. We have a huge net liquidity. So we are rather confident with our refinancing position.
All right, thank you so much for joining us. The Volkswagen Chief Financial Officer there, Arno Antlitz. It's a great pleasure to host you this morning on the program. Now, we're also moments away from that important S&P rate decision. Important for three reasons. First of all, it does seem that economists can't really get behind one view of what they'll do. So economists are really split three ways on how aggressive or not they'll be. Remember, if you look at inflation, it's the lowest in the OECD member countries. So let's see if we have it. We should be having the decision. There you go, raising policy rates by 50 basis points to 1%. So that was in line with what most major economists were expecting. But again, what's incredible is that of all the central banks, it was really a three-way split in terms of what they could have done. Now, any move which we've seen today is the third since the Swiss began raising rates half a year ago. And the divergence in estimates really did reflect limited signaling by the S&P and a relatively benign inflation and growth backdrop, which is very different to what we've seen at the ECB, which is very different what we've seen at the Fed and also at the BOE.
We're getting some lines as well from the S&P. Inflation likely to remain elevated for the time being, of course, within the context, as Francine was saying, of the lowest inflation within the OECD area. It sees 2022 CPI at 2.9%. 2023, it sees CPI, the S&P, at 2.4%. 2024 at 1.8%. I'm just looking at Euro Swissy. You're range bound now on Euro Swissy at 98. The NSB also saying that 2022 GDP should be around 2%, so around 2% for Swiss GDP in 2022. So a couple of lines there from the Swiss National Bank after they raise by 50 basis points to 1%, as had been expected by most economists. Global growth momentum has continued to slow, they say, and they see 2023 GDP at around 0.5%. That's 2023, 0.5%. This year, 2%. So a move down from 2% growth in Switzerland to 0.5% next year. Okay, let's get back to what happened at the Fed then and that decision and the comments from Fed Chair Jay Powell, who says the US Central Bank has more work to do in terms of raising interest rates and fighting inflation. Now, of course, attention turning to the BOE and the ECB with their rate decisions due later today, both poised to slow the recent pace of hikes. Joining us now in London is Bloomberg's Lizzie Burden, and in Frankfurt, of course, for the ECB decision, Maria Tadeo. Lizzie, let's start with you then. This is the first decision since Jeremy Hunt's fiscal statement. Will that play in to the decision-making of the BOE and its MPC?
Well, Tom, the short answer is no. The Deputy Governor, Dave Ramsden, has said that he doesn't think it'll have much effect on the rate decision itself because most of those measures take effect after the Bank of England's 3-year horizon. But it will be interesting to see how they impact on the inflation outlook, whether the Bank of England assesses that these measures were loosening or tightening in that regard. But what we will see is perhaps a change of tone in the exchange of letters between the Chancellor and the Governor, because the last time we had that exchange, there was a different man in number 11. It was Kwasi Kwarteng, and his emphasis was very much on growth. So you might see something different from Jeremy Hunt today. But you'll also have investors very much looking out for any hints about changes to the BOE's remit, because of course the Treasury is in control of that. But what we are expecting today is a half-point hike, as you say, to 3.5%, and that would be the highest level for the Bank of England in 14 years.
Lizzie, thank you. Maria, you're of course in Frankfurt waiting for the ECB decision. A hike well telegraphed. How much uncertainty is there around the size?
Well, yes, Francine, and at this point, I'd have to agree, too. There has been this almost change in the animal spirits overnight since the Fed decision. And today, the inclination here in Frankfurt is that we get a 50 basis points. That takes the deposit rate to 2%. Now, that's not the only big decision that will get taken today. We know there will be new growth projections. That is key when it comes to the debate of will there be a recession or not in Europe, for how long, what type of recession, and also the new inflation projections. And that is key for the medium term. But also, at one point, does the European Central Bank believe that inflation will peak? The final thing, very briefly, is QT. That is the next stage. Remember, Madame Lagarde has said that today she would lay out the principles. The market wants to know when, the timeline, but also the format. Will she go into detail? I think that really is the big unknown today in this meeting in Frankfurt. And Francine, on that note, happy birthday.
Thank you so much. There you go. It doesn't get better than a birthday present with 2 central banks. Actually, 5 central banks, I should say, including SNB, Tom.
Why wasn't that in the headline? Francine Lacroix's birthday. This is the headline of the day, of course. Maria, we're going to stick with you just for a second. I'm just looking at Swissy falling 0.5% against the dollar. It's also weaker versus euro by less. It's currently euro's up against Swissy by about a little over 1/10 of 8%. I don't know how much of that is down to Francine and how much of that's down to the ECB. Talk to us about the decisions, though, or at least the divisions around QT. You're very well sourced on the European Central Bank. What are you hearing as they lead up to kind of outline the blueprint for this into 2023?
Tom, that's a very good question. And again, as you know, these are important decisions that never get taken separately. Remember, the head of the European Central Bank, Madame Lagarde, has always talked about this holistic 360 vision. Of course, the rates and QT to some extent are connected. You can't talk about one without the other. Now, you could be inclined to think that if today we do get a smaller hike, perhaps that means that QT could come in earlier, perhaps that she would give in more details today to the market in terms of that preparation. But I think, to me, the real takeaway from this decision is not so much the rate hike. We know they're going to hike. We know that's been very made clear. But I think, to me, is the inflation projections. And again, QT, does she go into detail or actually keeps this vague to give herself leeway precisely going into 2023 with a lot of uncertainty around this economy still?
And Lizzie, I know the MPC split, of course, on what the Bank of England should do. I wonder whether they look jealously at the dot plot, because actually it's probably the most effective way of signaling what will happen in 2023.
There are certainly members of the Monetary Policy Committee who would love to have a dot plot, but I don't think it's coming anytime soon. But as you suggest, there is likely to be a split on the Monetary Policy Committee today. Nomura, JP Morgan, Bank of America all potentially see a 4-way split between 75, 50, 25 and no hike at all, because inflation's proving stubbornly, persistently high in the UK, but we would be hiking into a recession. So the Doves are worried about that. Call it chaos, call it a proof that we don't actually have groupthink at the Bank of England. It's very much somewhere that the bank's going to have to, you make your own mind up.
Okay, Lizzie Burden outside the Bank of England ahead of that decision. Thank you. On the divisions within the MPC, Maria today on the ground in Frankfurt, of course, leading up to the ECB decision. And what we hear from Madeleine Lagarde, as she was saying, around inflation and the plans on QT. Euro dollar at 106, the pound down by 0.6% now at 123. Let's stay on the central bank story. Joining us now is Catherine Nice, who's the PGIM fixed income chief European economist. To start with the basic question then, what do you expect from the ECB and how focused will you be on the language around QT, Catherine? Good morning.
Good morning. Very much agree with the comments just now, expecting a 50 basis point rise in interest rates from the ECB. Very much the risk around a 75 basis point hike. I think that has receded over the last couple of days, and the focus is going to be much more on the commentary, the language at the press conference in particular, as well as these plans and principles around quantitative tightening that we're expecting over the course of 2023. Where here, my sense is that the key thing for the ECB to do is to really well telegraph to markets what its plans are well in advance of taking an actual decision in order to allow the market to digest. So no surprises.
Catherine, why is the ECB actually slowing, rate hikes? Are they worried about the economy and so don't want to push it back into a deeper recession than it could already be in 2023? Or are they just waiting to understand the effects of their previous rate hikes?
I think it does reflect a couple of factors, and we do need to really focus on the fact that while inflation is high in both the US and in the euro area, the drivers are really quite different. It is much more externally driven, the inflation in the euro area, and therefore a little bit more outside the control of the ECB. You have seen over the course of this year a surprisingly resilient euro area economy. We're going to end 2022 with growth in Europe being stronger than what we've seen in the US. That said, my sense is that is very much reflecting good policies that were taken during the pandemic. So it's more of a rear view mirror reflection of where we're going, which in my view is going to be much more challenging. And you are seeing hints of that in the data. Consumer confidence, other measures of confidence, they've recovered, but they still remain very low. Industrial production, that weakness there is starting to broaden out across sectors, across countries. And we are seeing a steady chipping away at retail sales, reflecting that squeeze on consumers in Europe from higher energy prices. So all of this is pointing to a challenging period. The question is just, how deep is this recession going to be in Europe, and how prolonged might it be beyond this winter?
Catherine, does a reopen China next year, does that prove the catalyst for Europe? Do they come to the rescue of this ailing economy?
Well, you would do well to follow the outlook on China in order to form a view around Europe. China is very important to the European macro outlook, and certainly part of the reason why we've seen these hints of a slowing economy in Europe is reflecting what's going on in China. So the question, as you say, is does an improvement there bode well for Europe? And I would say, it's a bit of a double-edged sword, because on the one hand, having your key market do well is always going to be a positive. On the other, we are looking at a very particular and uniquely challenging energy situation in Europe. They have, first order replaced Russian gas with LNG, and much of this LNG has been diverted away from Asia. So if Chinese demand for LNG does pick up meaningfully and divert some supplies away from Europe, then, net, it may be less of a positive than it would have been in previous years.
Catherine, we've had a really large number, I would say, of central banks this week. What do you think is the economy that's trickiest to try and get right? If you look at the caliber and the tightrope that central banks are walking, is it the Fed, is it the BOE, ECB, or even Bank of Japan?
All of them are facing a tricky situation, and I do not envy, the decision and the responsibilities that they need to take. If I really had to pick out one that is just finding a really tough mix of challenges, even against what is a very challenging backdrop, I think I would have to say the Bank of England. It is really being affected by a multitude of factors. On the one hand, it has a very tight labor market, a bit like what you're seeing in the US, signs of overheating, inflation expectations, nominal wages growing at rates that are not consistent with the 2% inflation target, really ringing alarm bells with the MPC. On the other hand, we are seeing a massive hit to the UK's terms of trade from these higher European energy prices as a consequence of the war. That is acting as a real squeeze on households and firms and leading to a sharp drop-off in some of these near-term indicators. And how do you balance that as an inflation targeting central bank? That is a really tough position for the MPC, no doubt.
Yeah, it feels like a damn if you do and damn if you don't. Thank you so much, Catherine Neese there, PGIM Fixed Income Chief European Economist. Now, coming up, we'll have plenty more, of course, on these big central banks. Also, China could face a heavy COVID human toll, according to a recent study, while the latest economic data points to a worsening slowdown. So we'll have more details after the break. This is Bloomberg.
Of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
The European trading day. Quite a lot of pressure, actually, when you look at the European stock 600, down 1.1%. Again, this is after the Federal Reserve did rebuff expectations for a dovish tilt and said interest rates longer term could go higher for longer term.
Yeah, on that point, Fed Chair then Jerome Powell saying the US central bank is not close to ending its anti-inflation campaign, hinting at ongoing increases in the coming year. In the wake of a 50 basis point hike, policymakers projected rates would end next year at 5.1% before being cut to 4.1% in 2024, a higher level than previously indicated. Powell says the size of the next rate hike increase in February will depend on the data. China's economic activity worsened in November amid widespread virus outbreaks and restrictions. Retail sales contracted 5.9% from a year ago, worse than the 4% expected by economists. The jobless rate climbed to the highest level since May, while industrial output growth slowed markedly to 2.2%. More disruption is likely in December as the government continues its abrupt exit from COVID-0. US regulators are taking the first step towards the most widespread revamp of stock trading in more than a decade. It's aimed at spurring better prices for investors and directing more business to traditional exchanges. The SEC laid out 4 proposals it says will boost transparency and competition. The plan affects order routing, pricing, and disclosures that brokers must make to clients. Unemployment in Australia surged by more than 3 times economists' estimates last month. That's as unemployment held at a 48-year low. That is reinforcing expectations the Reserve Bank will raise interest rates further in 2023. The economy added 64,000 jobs in November, well ahead of forecasts for just 19,000. It suggests the economy is so far weathering the sharpest monetary tightening in more than 30 years. That is your First Word News.
Now, coming up, we talk crypto. The FTX saga continues. Bloomberg uncovers new details that may show why the crypto exchange's founder is accused of mass fraud. We'll discuss that next. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. Happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
On crypto, that it doesn't have intrinsic value, and that if people wish to invest in it, well, they must be prepared to lose their money. Now that may still be a case for investing. People buy things because of their extrinsic value, but we have to be very clear what it is.
That was the BOE Governor, Andrew Bailey, responding to our questions about FTX just 2 days ago. It was on Tuesday's Financial Stability Report press conference. Bailey, a known critic of unregulated digital currencies, did not comment on FTX specifically, although he was asked, but he did say it was a matter of the US, Tom.
Yeah, no intrinsic value there from Bailey, of course, of the BOE. Now, Bloomberg has learned that a former FTX executive shared computer code that hid mounting liabilities, a debt pile, at Alameda Research, sister trading company, of course, of FTX. Internal documentation offers clues to the origins of a mysterious account that a regulator alleges helped hide debts at Alameda. FTX's engineering director has not been charged with a crime and didn't immediately respond to requests for comment. Joining us now on the latest is Bloomberg's crypto senior editor, Ana Herrera. Ana, what do we know about these mysterious accounts?
So it was an account called the Korea account. Essentially, it was a way to mask that Alameda was getting more debt on the platform. We know from investigations, or at least this is what investigators allege, was that Alameda had sort of unlimited access to FTX customer funds, which it was trading, and Alameda was a hedge fund. So this is all quite jarring because it's kind of like basic no-no if this is actually what happened, because obviously there's still an investigation ongoing. And we'd spoken to Sam Bankman-Fried and Carolyn Ellison in August and asked them specifically about the relationship between the two firms, and they guaranteed that Alameda was being treated in a different way, and in no different way from anyone else. So it's quite, jarring to see what was going on.
So, and also, Senator Elizabeth Warren, of course, was warning that we may see more cases and charges brought against companies in the crypto space. Like, what do we know, and how long are we thinking about the timeline?
So, obviously, for now, Sam Bankman-Fried is under arrest, but there were he didn't run FTX on his own. So, the question is, how much did anyone else know? Are they collaborating? Are they not collaborating? Will anybody else be charged? In this case, so sort of the story mentions the head of engineering who was writing this code. Obviously we don't know if he was complicit or not, but it's a big question.
Meanwhile, the biggest exchange, Binance, saw some pretty significant outflows. CZ kind of pushed back on it on Twitter, said, look, it's not a big deal. This happens. We've seen it before. It's not as much as we've seen in the past. Things are recovering. How much concern should be focused on Binance? Are they being regulated? Are they being scrutinized by accountants? Are they being audited?
No one's really been audited as you would imagine, another a public company be audited. They have some extent of, they put out proof of reserves, but that doesn't really show liabilities. So, obviously people are a bit jittery now and concerned. If you had money on FTX from one day to the next, it would have disappeared. So you're now looking at the other exchanges and feeling a bit concerned. The outflows have sort of calmed down a bit, but still everybody's looking at everyone at the moment.
We were talking about this yesterday, right? CZ, the head of Binance, was trying to reassure, is there anything that regulators can do to help in this way, or it just doesn't match? Regulators don't really look at the space.
So it would be good to know where they're headquartered, to know who would regulate them, but obviously I guess it also depends effectively where you have operations to know who would regulate you. But yeah, I guess regulators are likely to clamp down a bit more on everyone who's remained standing, but having audits would be helpful for investors, I would imagine.
Okay, Ana Herrera on the latest when it comes to FTX and the read across as well to Binance, our senior crypto editor there, Ana Herrera. No doubt we'll be getting Ana back on shortly as well, I'm sure, as the story unfolds. Now let's take a look at some of the events we are following today. Of course, at 12 p.m. UK time, it is the Bank of England's rate decision. The central bank is expected to hike by 50 basis points. There is division, though, within the MPC. That's followed by the ECB rate decision shortly after 1 p.m. UK time. Of course, expected 50 basis points in terms of the hike there. Then it's US initial jobless claims, retail sales and manufacturing data at 1:30 p.m. UK time. And finally, shortly after, we have US industrial production data. Francie.
And then later today, of course, it's our UK-focused show. Don't miss our interview with Charles Goodhart, Emeritus Professor of Banking Finance at LSE, former MPC. That's shortly after 9:30 a.m. London time. So we'll have a full roundup of the top UK news. We'll look, of course, at the BOE Decision Day guides, and we'll have a look at what's coming up in terms of strikes, and, of course, well into 2023.
Markets here currently in Europe, currently down 1%. Futures in the US down 0.7% on the S&Ps. That's it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance, Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Fed Chair Jay Powell says rates will climb higher and stay there longer than markets anticipated after the FOMC hikes by 0.5 point, while Wall Street drops. Asia stocks follow. Next up, Bailey and Lagarde. Policy decisions are front and center in Europe. The BOE and the ECB seem following the Fed with 50 basis point rate hikes. Plus, documents show FTX executives may have used computer code to mask Alameda Research ballooning debt. Now, we're getting some breaking news. Maybe we've gone to the markets, but also we're getting a Norges Bank. This is a very interesting bank because we've spoken in the past to the central bank governor who gave us more of a guidance than maybe some of the bigger banks about what he was intending to do. Today, they've raised the benchmark interest rates to 2.75%. Now, that's pretty much in line with expectations. This is what most economists had predicted, which is why we're seeing actually movement on the Norwegian krona fairly muted. On to the rest of the markets. 5 big central banks today. We not only have the S&B, we not only have Norges Bank, but some of the other ones further afield in the emerging markets. And then the focus, of course, firmly on the BOE and the ECB. Now, the S&B, the Swiss franc, was an interesting one because out of the inflation figures that are pretty high in the OECD, Switzerland is actually not seeing as high as inflation. It's the lowest amongst OECD member countries. They hiked as expected, and you can see a Swiss franc at 0.9290. I don't know whether we have an asset class for you, but the main interesting story is exactly what we're seeing, for example, on not only euro dollar, but a bit of pressure after we heard Jay Powell on the dot plot really tried to hammer that message home to the markets that, look, next year there are more hikes coming and they will probably stay there for longer. All right, let's look at the European map. Maybe that gives us a clue on the difference between, for example, a CAC 40 where we're seeing pressure down at 1.1%, DAX. Of course, we firmly look at Frankfurt because of that decision from the ECB, and of course that's also followed from a press conference from Christine Lagarde. We're not getting a press conference from Andrew Bailey of the Bank of England today. So it's shaping up as a big week for central banks. Yesterday, we all know the Fed decided on a 50 basis point hikes. Today, as we've been telling you, BOE and the ECB both poised to slow the recent pace of hikes. We're now joined by Georgina Taylor, fund manager in Invesco's multi-asset team. Also with us, our Bloomberg markets and quants reporter, Justina Lee. So thank you both for joining us. Justina, let's kick off with you. What are we, in terms of what's most important, I think the Fed really gave a tone of, look, we're tapering for now, but we're not done hiking. Are we going to see and hear the same from the ECB and the Bank of England?
Yeah, I mean, investors are certainly expecting a similar decision from ECB and the Bank of England in the form of a 50 basis point hike. And I think we have already seen signs of, inflation easing in Europe, and people will certainly be on the lookout for whether central bankers are acknowledging this. Because in the US, I mean, we've kind of seen mixed signals, between the PPI and the job reports, and of course, the better than expected CPI last week. But the message coming from Fed officials is that they're looking for, not just one report, but maybe a series of them to confirm the fact that inflation is in fact decelerating in the US.
Georgina, where are you expecting the most fireworks to be, or what could be mispriced in the markets depending on what central banks say?
I think it's the general tone. I think the shock last night was certainly how long rates could stay on hold for once they do reach the peak that they end up hiking to. And I think, today it's about the rhetoric and the messaging. I think what's quite interesting about today is that you might get quite a different message out of the Bank of England versus the ECB in terms of that direction of travel. Maybe the Bank of England wanting to contain things slightly because we have a slightly different mix of economic challenges in the UK. So maybe actually, the interest and excitement could come from the ECB, and particularly what they do on the quantitative tightening side as well. But there is a huge amount for markets to grapple with. So I think it will be a combination of today plus what was said last night for people really trying to take a view on where to go and where to position going forward.
Georgina, what are you expecting from the ECB actually on, preparing the market for QT? I feel like the market in certain parts of what they're hearing, but they're not actually listening to what central banks are saying. Is QT one of them?
Possibly. And I think it's, I don't exactly know, the way that things will go today, but I think things will be said and things will be mapped out. And I think from a markets perspective, we are dealing with a combination of events and policy changes that we just have not seen and had to deal with before. And I think the market is digesting that we are genuinely in a different investment regime now. And I think that is almost being seen in exactly what's happened this week. After a softer CPI data, we all got excited that maybe, hikes won't be as aggressive as we were starting to think. We were going back to an investment environment that we understand, pulling ourselves back to maybe something that looks more familiar. And last night was a reminder that things have shifted and they have sizably changed for markets. And I think that combined with comments today will be the ongoing surprise for markets.
Justina, talk to me a little bit about whether you were surprised by the market reaction to the Fed not being as dovish as they were expecting. I mean, they have told us, week and week over that rates will have to go higher just to get to their target.
Yeah, it's kind of interesting because we did see a return of a lot of the tightening trades. Stocks were down, bond yields were up, the dollar is up today. But at the same time, if you look at expectations for the peak rate next year, it actually didn't move that much. And I think by some people's, calculations, and in fact, the bond yield probably maybe did not move as much as what some people would have expected. And I think what this shows is, partly markets, investor skepticism that things really are, will not change, because ultimately we have seen the CPI easing. They're increasingly concerns of a recession, especially if you look at the yield curve. And so I think investors are still a little bit skeptical about whether the Fed can stick to this tightening path, even though yesterday was certainly a reminder that they plan to stick to that, and then they're more worried about stopping tightening too early rather than the reverse.
Georgina, you prefer credit over equities right now. What would need to happen for that to be reversed?
Yeah, I'm slightly worried about it because I feel it's quite consensus, because this crisis hasn't come and emanated from the corporate balance sheet. It's been other factors that have driven it. I think really for us to change that view would be how deep the earnings downturn turns out to be. I think that feels to us the bit that hasn't really been repriced. It keeps the risk in equities, which is why we prefer credit. We think you're paid a little bit more in credit to take that risk, but there is an assumption that default rates aren't going to go up a huge amount. And the longer this goes on for, the longer this persists, those risks rise. So to be reviewed as kind of these economic challenges play out.
I think you've also reduced your long US dollar position. Again, is that with conviction?
Yeah, it's hard. We've held on to some dollar exposure. I think we're just very aware that everything was aligned for the dollar in 2022, and there's been a cyclical support for the dollar as well as a defensive support for the dollar. I think now those interest rate differentials shift. We're seeing other central banks responding. They're hiking rates. Maybe it's not all about the Fed, and so the dollar might just come under a little bit of pressure. Today aside, there's a bit of support there, but I think you have to be a bit more careful. And also from a multi-asset perspective, is the dollar your diversifier? It's been hugely beneficial to hold the dollar this year. It may not be necessarily the diversifier going into 2023, and we're just aware of that, so spreading that risk a little more broadly.
Justina, how much volatility do you think we'll get into the first couple of months of 2023?
Oh, wow. I mean, I think that, probably quite a bit. Because what I think the Fed report confirms yesterday is, people will still be looking at all the reports that points to, price pressure, from the jobs one to PPI to CPI. And at the same time, there's almost like a conflicting narrative out there, because there are also concerns that we might be grappling with a recession. And in that case, what does that mean for bond yields? And what does that mean for all these downtrodden tech stocks that investors have basically abandoned this year?
Yeah, great. Thank you both, of course, for all of the insight. Georgina Taylor, their fund manager in Invesco's multi-asset team, and our Bloomberg Markets and Quants reporter, Justina Lee, joining us this morning. Coming up, we'll have a full countdown, actually, to the ECB rate decision today, with the central bank poised to slow the recent pace of hikes. We discuss QT next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's talk about the ECB. It's also due to make its latest rate decision later today. So, of course, we have the BOE, we had the S&B, we had Norges Bank, and now it's a turn of the ECB as well. For more, we're joined from Frankfurt by Bloomberg's Maria today. So, Maria, a hike, well telegraphed, but how much uncertainty is there around the size?
Well, very well telegraphed. And Francine, over the past 24 hours, I think it's very fair to say some of the uncertainty, the animal spirits around the size of this hike have now flipped. And the inclination today in Frankfurt is that we go for 50 basis points. That takes the deposit rate to 2%. And of course, that wraps it and does it for the year. And now we do get confirmation of that 50 basis points, and that's 250 basis points in 1 year. It's the fastest on record for the ECB. It really speaks to the challenge of inflation that they have. And on that note, Francine, it'll be interesting to see their new economic projections. They will upgrade both GDP projections. Again, the debate of a recession, yes or no, what type of recession, but most crucially, and this is a number to focus on, is the medium-term inflation. At one point, does inflation peak in the eyes of the European Central Bank?
So, Maria, the other big question, of course, for the ECB is what kind of blueprint, how will they guide the markets towards QT?
QT. And Francine, in some ways, they have done the prep work for this. We've talked about this huge reversal in the rate cycle, the 200 basis points, potentially the one to come now, the early repayments of the TLTROs. That's, again, an idea behind this is to drain liquidity off the system. So obviously, the next logical step is QT. In fact, the head of the European Central Bank has also promised that today the market would get the principles. But there are real questions about this. Will she go into detail? Will she keep it vague? Of course, the market, they want to know the timeline. Is it an early QT, or do you wait until Q2 next year? And of course, the format. When we speak for QT made by the European Central Bank, what does it mean? I think to me that's a real question. She will be hammered on this in the press conference, but the attention will be on the amount of detail that she's willing to give today.
Yeah, but of course, watch that press conference very, very closely. I know we will. Maria, thank you so much. Maria Tadeo there in Frankfurt for us. Now, let's also get the latest on the crypto front. Bloomberg has learned that a former FTX executive shared computer code that hid mounting liabilities at Alameda Research, a sister trading company of FTX. Now, internal documentation offers clues to the origins of a mysterious account that a regulator alleges helped hide debts at Alameda. Now, FTX's engineering director has not been charged with a crime and did not immediately respond to requests for comment. So to unpack all of this is Bloomberg's crypto senior editor, Anna Herrera. Anna, I have to say this reads more like a mystery every day with all of the intrigue and, of course, things that we don't know in investigations. So what could it mean, if this proves to be true, and what does it mean for Sam Bankman-Fried that's already been charged with a number of things?
Well, the CFTC investigation, there are multiple investigations, showed that Alameda Research had basically unlimited access to customer funds, FTX customer funds to trade. And so sort of our story shows that perhaps some of that might have been in an account that was coded so that you could hide it and other people might not see that it was Alameda's account, but it looked like someone else's account potentially, or some other form of account.
So at the moment, we're just waiting for it to play out, right? It feels like every day we're talking about Binance, and I know you're on top of all of this. Like, where do we go next in this investigation?
I think that we might hear more from other people that were involved. Obviously, Sam Bankman-Fried didn't run his empire all on his own. There were a number of lieutenants. We don't know how or if anyone was involved or will be charged or if they're collaborating, but that might be another thing to follow for sure.
Senator Elizabeth Warren also warned that we may see more cases and charges brought against other places in the market. Is she one of the most vocal senators in the U.S.? I mean, all of this is happening, or most of this is happening in the U.S.
Yes, yeah. I guess she has been one of the proponents for more regulation of the space. And this sort of shows that perhaps a little bit more regulation would have helped, or even just following the regulations that were in place. Because obviously if they're being charged, then it means that there was something that they didn't follow. But one of the things that senators and policymakers and regulators across the world have been warning is this lack of separation of powers in exchanges that poses potential conflicts of interest. You see here a hedge fund owned by the exchange and the money being commingled.
And we also saw some record outflows from Binance yesterday. Again, how do we get upfront on it? What does it tell us about the linkage and the fact that also CZ of Binance tried to, stem the outflows? I don't know how successful he's been.
So the outflows have calmed down a bit, and I think it's outflows have peaked across exchanges in general. That's because investors are a bit wary now. Of course, they've seen multiple centralized companies collapse. If you had your money on FTX a month ago, suddenly it was gone. So you might be a bit wary of leaving it on another exchange, even if you think perhaps the exchange is doing fine. And it's a cyclical thing, but the confidence has kind of dropped dropped on centralized exchanges for sure.
And who do we know has lost money? And I know we were talking a bit about it yesterday. It could be some institutional investors, but is it like the moms and pops that just had retail investments into, or their savings into this?
So FTX was known as like a traders exchange. It was their slogan was built by traders for traders. So it's likely that a lot of the big losses were big players. And we've seen a creditors list, but it has been redacted, so we don't know who's on it. But they did have 1 million creditors. So a lot of them will have been normal people who put their savings or something in there, both on the US exchange or even on the international one.
And they wouldn't be protected, right? There's no, because it's not really regulated, it's kind of,
yeah, it's not,
if you
not
call it the Wild West, but it's not, there's no one that you can go to and say,
there's no insurance, right? It's not a bank account where you have FDIC protection and there's insured to a certain amount. So that's part of the problem. Many of these firms sort of said it's like we're like a bank account. You can pay back. We'll give you interest on your deposits, but that kind of gives you the impression that it might be like a bank account and insured, but it's not. So yeah, that's a big problem.
Anna, thank you so much for all of the insight. Of course, Anna Herrera, one of our senior editors, and she will continue bringing us up to date with all the crypto stories. Coming up, China could face a heavy COVID human toll, according to a recent study. We'll have the latest economic data points as well as they point to a worsening slowdown. That's coming up next, and this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Fed Chair Jerome Powell says the U.S. central bank is not close to ending its anti-inflation campaign, hinting at ongoing rate increases in the coming year. In the wake of a 50 basis point hike, policymakers projected rates would end next year at 5.1% before being cut to 4.1% in 2024, a higher level than previously indicated. Powell says the size of the next rate increase in February will depend on the data. Now, China's economic activity worsened in November amid widespread virus outbreaks and restrictions. Retail sales contracted 5.9% from a year ago, worse than the 4% expected by economists. The jobless rate climbed to the highest level since May, while industrial output growth slowed to 2.2%. More disruption is likely in December as the government continues its abrupt exit from COVID-0. U.S. regulators are taking the first step towards the most widespread revamp of stock trading in more than a decade. It's aimed at spurring better prices for investors and directing more business to traditional exchanges. The SEC laid out 4 proposals it says will boost transparency and also competition. The plan affects order routing prices and disclosures that brokers must make to clients. HSBC says it will no longer finance new oil and gas fields and related infrastructure projects, a move that climate activists say puts it ahead of many peers in addressing global warming. The new policy covers both loans and debt underwriting. HSBC has been among the world's biggest financiers of fossil fuel companies, helping provide more than $110 billion of debt since the Paris Agreement was signed back in 2015. Unemployment in Australia surged by more than 3 times economists' estimates last month, as unemployment held at a 48-year low. That's reinforcing expectations the Reserve Bank will raise interest rates further in 2023. The economy added 64,000 jobs in November, well ahead of forecasts of 19,000. It suggests the economy is so far weathering the sharpest monetary tightening in more than 30 years. And Elon Musk has sold another block of Tesla shares worth at least $3.5 billion. An SEC filing shows he unloaded at least 22 million shares over the past few days. Tesla closed on Wednesday below a $500 billion valuation. Now, that's for the first time since November 2020. Shares are down 55% so far this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. The picture is one of central banks. There's a lot of central bank action. I know we have a full roundup of decision day guide, not only for the ECB, but also for the Bank of England. That's coming up. But in the meantime, Norway Central Bank raised borrowing costs to the highest level in more than a decade. So actually, first, let's start with SNB, the Swiss National Bank, raising interest rates by 50 basis points. Again, this is a third salvo against inflation that narrows the gap with the borrowing costs of global peers. And then Norway also raising rates. Coming up, we focus on the UK.
much of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK, a news show with a special focus on the biggest challenges facing the British government: economy, financial services and markets. I'm Francine Lacqua here in London. Now, on the show this week, the Bank of England actually takes center stage in a hectic week for central banks across the globe. The BOE will probably slow the pace of tightening on concerns that the UK recession will deepen. We'll break down what it means for the British economy with Charles Goodhart, former BOE chief advisor, and Victoria Clark, the UK chief economist at Santander. Plus, the Chancellor of the Exchequer, Jeremy Hunt, finds himself in the company of Tom Cruise and Kim Kardashian. All three make it onto Bloomberg's top 50 people who defined global business in 2022. So we'll talk about that and the strikes. Now, the Bank of England is due to reveal its latest rate decision later today. The central bank, of course, is poised to slow the recent pace of interest rate hikes. Now, for more on all of this, we go straight outside the Bank of England, just moments away from our central headquarters in London, where Lizzie Burden is standing by. So, Lizzie, investors and economists are expecting a half-a-point hike. What else are we looking for today? I think we're having a couple of technical difficulties when it comes to Lizzie Burden, who's just outside the Bank of England. Sometimes the closer you are to headquarters, the more difficult it is to get the sound up. We'll get a full debrief, of course, from Lizzie Burden, but this is what we're looking for. First of all, we're expecting almost a 50-50 split when it comes to MPC members. The tricky bit, of course, of the situation is that just like the Federal Reserve in the U.S., you don't want to hike rates too much to deal with inflation, because that would unduly push the economy into a recession. The trick here in the UK is that it's even more complicated than in other parts of the world. So let's maybe have a look at what investors are expecting. In terms of what we heard from Andrew Bailey, I was at a press conference on financial stability 2 days ago. Now, it would have been, of course, completely illegal for him to talk about what we're expecting today. But look, this is what we know in terms of policy statements and exactly what it would boil down to. So the decision day guide is really that we're expecting the Bank of England to temper rate hike aggression, I guess, to see how it pans out, see how the previous hikes impact the economy. And of course, the concern is that overly aggressive action might unnecessarily deepen the recession in 2023. Now, to talk about all of this, we're joined by the former chief advisor at the Bank of England, now emeritus professor at the London School of Economics. He is one Charles Goodhart. Mr. Goodhart, thank you so much for joining us. How worried are you that the Bank of England is actually late, they're behind the curve, and now they temper some of the hikes?
I think that they moved far too late, though I can understand why. And I think they're still too low. My expectation and the market's expectation is that they will raise rates by 50 basis points today. There's a possibility that they might increase that by less. There's a faint possibility that they might increase it by more. I would have liked that, but I think it's unlikely.
But is it also unlikely that it will pause its hiking cycle too soon? So is the message similar to what we heard from the Fed, that they will stay aggressive for longer, but for the moment, not as aggressive because they're not quite sure what happens early 2023?
I think the Fed's position on this is absolutely right. I'm frightened slightly that there'll be more doves on the Bank of England's monetary policy committee, and that they will stop the hiking cycle too early and before they can be sure that they will get inflation back to target.
All right, Mr. Goodhart, let's also bring in Victoria Clark. She is UK Chief Economist at Santander's Corporate and Investment Banking Division. Victoria, thank you for joining us. Look, the way the 9-member MPC actually operates is, of course, different to the Fed. I wonder whether most of them would have loved to have a dot plot, because that would give us a very clear indication of what the terminal rate, where they see interest rates longer term.
Well, we think that the BOE is quite reluctant to have a dot plot. I mean, it was happy to send a message in November because it was trying to get mortgage rates down, and so it wanted to really try and send a message that it thought market pricing was too aggressive. But actually, it doesn't want to send an explicit message because it isn't quite sure how far rates are going to need to go and how long it's going to hold them there. So in a way, it's quite happy keeping things a little bit vague. Perhaps I agree with Charles that you might get a little bit of a dovish message today because they are that worried about the housing market.
What do you worry about the most? Is it under, I guess the question is, what's the worst of two evils? Is it hiking too much or hiking too little?
Exactly. Lots of bad options. I think at the moment they have, they put out a huge amount of rate rises. They're starting to see the impact of that on the economy. But you've still got much too much pay growth. And, inflation is, far from on a clear, decisive downward track. So they need to keep going for the time being, but they've got to be a bit careful. So I think that, at the moment, for them, the balance of risk says, look, let's go a little bit more slowly this time with 50 basis points and again in February. But they have to be mindful of how much they've done. And I think you'll get a little bit more of that with the voices of the doves, a couple of dissenting doves today.
Yeah, this is a concern, right, Charles Goodhart, is that you also have to take into account the hikes that you've done so far to basically game theory. You're not only data dependent, because that could possibly lead to a mistake. I think we have a great chart of the MPC looking at the hawks and the doves. If we have a 4-4 split, which way do you think Andrew Bailey will vote? Which way would you have voted, Mr. Goodhart? Okay, we're not having much luck, actually, with technology this morning. This is the picture, Victoria, of what we're seeing, how the 9-member MPC basically will decide on rates. Last time officials, I think, voted 7-2 to lift rates to 3%, and that was the highest level in 14 years. The dissenters were Swati Dhingra, who voted for half a point rise, and Silvana Tinreira, who preferred a quarter point. How do you think it'll be today?
This time, Dhingra, no change at all.
Yeah.
Tinreira, no change at all.
Yeah.
Dhingra, 25 basis points. Most of the committee, including Andrew Bailey, for 50, and then Catherine Mann for 75. So a very, very divided MPC in a very different mindset direction to the Fed, which is a much more chair-led institution.
Yeah, and Victoria, of course, what we want to know, and we're hoping to get it today, is actually when the BOE hopes and thinks that inflation could be at target. We had that faster inflation fall. Now, I know it's easier, right, economically, to go from 10% to 5%, and much harder to go from like 5% to 3% inflation. So what are the dynamics of inflation that you're expecting?
I think that's it. So we've had a bit of a drop in headline inflation. Services inflation actually is still rising, and I think this is going to be a worry. You know, for the hawks on the MPC, there's still plenty there. Strong pay growth figures this week. Yes, inflation probably has passed its peak, but it's probably still going to be close to 10% by March and close to 7% by next summer. So this isn't, you know, inflation, embedded inflation risks dealt with. They've still got this inflation battle to tackle. So they have to get that balance. They have to show an awareness of a slowing economy, but also show that they are committed to the cause on inflation.
I don't know whether we have Mr. Goodhart, actually, or not. I don't know whether we fixed the technical difficulties. We made some great charts for you, Victoria. We have 3 charts that are absolutely killing it in terms of how you break down, first of all, national asking prices for houses. That's by right move. Inflation, of course, outpacing wage growth, and then some of the energy component of inflation. So let's see if we can get a chart up for you. Bloomberg does this better than anyone because we have all the data, of course, at our disposal. I mean, the concern is there any chance that inflation could come down as quickly as it came up?
I don't think so. I mean, look, there's always a chance because in this world, we're looking at big geopolitical forces, looking for what the news is with regards to the war in Ukraine and gas prices, and all of these things mean that there are bigger possibilities and ranges of uncertainty than normal. But really, you know, it looks as if we're going to be pretty sticky with UK inflation and actually stickier than overseas because of the way that our energy prices work. So, I think that the risk for the Bank of England is that they're looking still at sticky inflation and upside risk to inflation for longer.
Sure. Let's also look actually at wages, and we look at real wages, and of course we're in the middle of strikes. It's Royal Mail, it's some of the rail. I mean, as an economist, how much do increases by nurses from the NHS actually feed to inflation? I mean, it can't be that much.
It shouldn't be that much because these aren't, these wage settlements aren't going to lead to increases in, big company selling prices. So, at face value, you wouldn't look at this and say, look, this is massively inflationary. The headline pay growth figures have, of course, been held down by the fact that public sector pay has been running much, much below private sector pay. And, perhaps there is an element of this throwing focus on the issue of the tight labour market. The strikes perhaps make other people think, OK, what am I going into my pay negotiation and pay settlements with? And so it probably doesn't help that environment of, concerns and upward pressure on pay growth at this point in time.
Victoria, thanks so much. Victoria Clark there, Santander's UK Chief Economist, stays with us, and we'll try to get back to Charles Goodhart. He's Emeritus Professor at the London School of Economics and, of course, ex-Bank of England. Now, coming up, we'll have more on the UK with our panel when we focus a lot more on some of the great growth, but actually what we'll talk about is also housing prices and the likelihood of a housing crash. That's coming up shortly, and this is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, let's talk, of course, a lot more about the UK wages. They're rising at close to a record pace, maintaining pressure on the Bank of England to keep hiking rates despite a worsening economic outlook. Now, those gains far outpaced by inflation, with consumer prices rising 10.7% in the year to November, fueling a growing wave of strikes across the country. Now, we're rejoined by Victoria Clark, UK Chief Economist in Santander's Corporate and Investment Banking Division. Victoria, thank you so much, first of all, for sticking around. We're talking a little bit about strikes and the fact that, you know, from a purely economic point, maybe it doesn't have that much of an impact if NHS nurses, who frankly deserve it, get a pay rise. But talk to me about the impact of strikes. So we're hearing about cancellations. Yeah. How difficult is it to model the impact, the negative impact this would have on the economy?
It's pretty difficult. I mean, particularly given that, you know, when we're looking back at the data, we haven't seen strikes impacting the number of working days that we're likely to see in December since the late 1980s. So we don't have good comparable data. And of course, we know that everybody's become much more adept at sort of flexible working, where that's been possible through the pandemic. So, you know, one could say the disruption that you'll see from that striking might be less this time around. But it, of course, comes at a really critical time for the economy. Retail firms under pressure, you know, big pre-Christmas restaurant, hotel, hospitality bookings, and these are segments of the economy that are really struggling under the pressure of high energy prices. So, I mean, I think it will have a really big impact. You know, the December GDP figures will probably show that. And the question is, how much of a bounce back do we see in January, and which businesses are in such a vulnerable position that this may be the last straw for them?
Victoria, do you see some kind of event? I mean, I know there, gilt markets were all over the place, and we really came very close to a disaster, really. And the Bank of England keeps on saying, look, we need to fix that part of the market. Is there anything that you worry about that's systemic? Is it mortgages? Is it housing? Is it something else?
If you look at what the Bank of England was saying in its financial stability report this week, I mean, it sees lots of pockets of really big pressure, but nothing that it, at least wants to fess up as being systemic. And of course, it can't say that. But there are some enormous pressures here. I mean, record squeeze to real household disposable income over the next year. Households facing mortgage increases of probably £3,500 more annually on average if you're looking to refinance onto a fixed rate. So some really big pressures that are going to come in. And I think, it's how these come together that's going to be the big test.
Yeah, I mean, the housing for the UK is very crucial. I mean, it's not as crucial as Sweden, or certainly we haven't seen that kind of house price drops because we've gone through it about 10 years ago. Yeah. But what are you worried about? Is it house prices? Is it mortgages? And we have a great chart really looking at, for example, I think this is a right move chart looking at UK house prices, and they fall, about 10%, and they could go even lower.
So certainly the momentum's there, negative momentum in house prices. We're seeing, big drops in the indications of buyer appetite. That all becomes more self-fulfilling the more we hear talk about house prices falling, because that puts off prospective buyers. So I think that momentum's there, and as you can see in the right move data, we are seeing more signals that that's going to continue. The fact that the jobs market is so tight probably helps. That should help to limit the extent of the falls. But I think that the momentum that's there at the moment is going to keep that going. Of course, prices have come up a lot. We've had stamp duty, land tax incentives, which have led to big rises in prices over the last 2 years. So, one argument would be that this is a bit of an adjustment backwards from that.
But we need people to be able to repay mortgages. And for the moment, a lot of them are fixed. A lot of them will drop off fixed in 2023. Yes. And how much of a disaster could that be?
It's a big cliff edge. You've got about 50% of households coming to, refinance at these higher rates in 2023. So that is massive. And as I say, £3,500 a year is a massive amount of money. So that affordability pressure is there. I think that, this time around, we've seen a bit of news on this in the last week. Lenders will be encouraged to look at, ways to help people manage this, interest-only mortgages. So there are routes to try and help people through what's probably going to be a 1 year pressure point. And then let's say inflation does fall, when the Bank of England could be cutting rates again a year from now. And I think that's probably what it's hoping, that it can deal with the inflation, and then hopefully ease some of that pressure on those households facing the high mortgage rates.
Victoria, on jobs, and I keep on hearing, look, we could just about muddle through as long as the labor market, it's tight, but it holds on.
Yes.
There was also a weird phenomenon that it's older population coming back into work. Now, this is one of the great mysteries for me, because I go to the Bank of England pressers, and they talk about, of course, long COVID and the effects. Is this the older workforce coming back because of the cost of living crisis, or because actually they're less sick?
So, I mean, the big picture, right, is that we still have many fewer people actively in the workforce than we did before the pandemic. And you're right, we've seen some hints of some movement back, and that may well be related to cost of living pressures. But that, there's still a big imbalance there, and it's trending in the wrong direction for the UK. And in many of our peers, economic inactivity, the people that have stepped outside of the workforce is starting to shift back, whereas in the UK, the trend actually has been that it's carried on worsening. And, well, there's lots of different theories out there. One thing we've been looking at is perhaps the role of NHS waiting lists in keeping people out of the workforce and long-term sick from COVID. And if that trend continues, that only adds to this long list of very difficult issues for the Bank of England, for the UK economy, and potentially more persistent pay growth as well.
Victoria, thank you so much for all of the insight. Victoria Clark, their UK Chief Economist at Santander, in Santander's Corporate and Investment Banking Division, joining us this morning. Coming up, we'll have plenty more, of course, on the UK. Jeremy Hunt among the Bloomberg 50, a list of those who've defined business in 2022. It's not every year we get a UK chancellor on that list, so we'll talk about why he made it and who else is on the list. And that's next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
One covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. So it's one of my favorite days of the year because Bloomberg has published its annual list of 50 people who defined global business in the last 12 months. Now, this year's Bloomberg 50 includes names across politics, sports, science, and entertainment. Among the global list, one name stands out here in the UK, and that's the Chancellor, Jeremy Hunt. So for more on all of this, let's talk to Bloomberg's Adam Blenford. So Adam, I was really surprised because it's not I love this list. We look at it every year. You put it together every year. I haven't, in recent memory, remembered when there was a UK Chancellor on it. So why is Jeremy Hunt in the top 50?
Well, thanks, Francine. Thanks for having me. And it's a collaborative effort between many people in the Bloomberg newsroom. But one thing about Jeremy Hunt this year, of course, is that if you cast your minds back to the economic and fiscal chaos unleashed by the mini budget during Liz Truss's prime ministership, Jeremy Hunt was parachuted in as a sort of emergency chancellor. And very quickly, in a chaotic year for the UK, when you can't say there were that many standout superstars, he became pretty much the most important person in the country. Remember that time, Truss was still prime minister in name, in power, in office, but not in power. And Hunt was there for a week or two, put his head down in Downing Street, reorganising the economic sort of background of the UK, trying to calm the markets, bringing down bond yields, which had risen way over 4%, and attempting to kind of redress the balance. Eventually, of course, he was kept in office then by the new Prime Minister, Rishi Sunak, where he still remains, and he unveiled an autumn statement, a big budget in all but name, attempting to, which included tax rises, and the promise or the threat even of spending cuts, public spending cuts down the line in an attempt to balance the books again. So he became really the man with the sort of future of the UK in his hands very quickly, almost overnight.
I mean, I just love, and he probably love it too, that he's on a list with like Tom Cruise and Jennifer Hudson. So because this is Bloomberg UK, who else has made it from the UK?
Well, like I said, perhaps it wasn't a standout year for the UK. People who have been active in the UK and with the UK this year include the new owner of Chelsea Football Club. Of course, if you, again, cast your minds back, of course, Vladimir Putin's Russia invaded Ukraine, and all of a sudden, all of those oligarchs and tycoons had their assets frozen. Chelsea Football Club, one of the biggest jewels in the Premier League, was in the hands of Roman Abramovich for 20 or so years. And Todd Boehly, a US investment manager, multi-billionaire chairman and founder of Eldridge, he stepped in and masterminded a bid to take over Chelsea for, I think it was something like over $5 billion. He's unlocked that club, given it a bit more of hope in the future. But he's also a new player in the sports scene, attempting to bring that kind of American billionaire style back into the Premier League. So we'll see where that goes. There are others in the list. It's a very diverse list as well.
It is. I love it. I mean, it is. We've had such a tough year, actually, in terms of Ukraine, in terms of markets. It's a nice list to also remember some of the do-gooders of this world. Adam, thank you so much. Adam Blenford there from our UK website. Be sure also to subscribe to Bloomberg's In the City podcast that I host along with David Merritt on Apple Podcasts. This is Bloomberg.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you about that?
I can imagine.
Instagram moment with the sunset, you're having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate.
It may be that 5 to 5.25 is not enough.
With inflation running between 5 and 6%, they would have to raise rates to above 6%, somewhere between 6 and 8%.
The full effects of our rapid tightening so far are yet to be felt.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Fed Chair Jerome Powell sees interest rates being higher for longer, but investors see the outlook for next year a little differently. The Bank of England and the European Central Bank are out with their own rate decisions today. Both are likely to slow the pace of rate hikes. And Elon Musk unloads Tesla stock for the 4th time this year. He sells another $3.6 billion worth of shares. Welcome to Bloomberg Surveillance. This is the early edition. I'm Anna Edwards in London with Kaylee Lines in New York. Matt Miller is off today. And Kaylee, it seems the market not entirely convinced with the extent of hawkishness we saw demonstrated by the Fed yesterday. But that didn't stop market participants feeling nervous about holding risk. And we've seen a bit of a sell-off in stocks.
Yeah, and that definitely was the case in Asia overnight, Anna. Whether that was entirely due to the Federal Reserve yesterday or if it had more to do with the data out of China, though, that is my question. The MSCI Asia Pacific Index as a whole was down by about 1.5%, but that China data was really, really weak. Both business and consumer activity in November dropping to the lowest levels since the Shanghai lockdown back in the spring. You had retail sales, home sales, industrial output falling, unemployment rising, all of it really pretty ugly. But of course, that was before they partake upon this big reopening of the economy. The question is, does that help or hurt more initially as cases are spreading throughout the country? So off the back of the weaker data, the Chinese yuan weakening as well against the US dollar by about 0.5%. 697.70 is where we trade. But while the data was weak in China, it was actually really exceptionally strong in Australia and New Zealand. In Australia, jobs coming in much stronger than expected in New Zealand, GDP coming in much better than expected. And as a result, that is leading to bets on even more tightening in the new year from those central banks. And so the 10-year yield in Australia up 9 basis points to 3.45, and the 2-year in New Zealand up 16 basis points overnight to 4.83. Now, as for here in the U.S., as Anna mentioned, it wasn't necessarily taken as an extremely hawkish Fed decision by the market yesterday. Yes, we ended lower, but off of session lows in the equity market, and then the bond market yields actually fell slightly. The question is the market missing what the Fed was actually saying? But they seem to be singing a more negative tune this morning, with S&P 500 futures down more than 1%. And in the bond market, yields moving a bit higher at the short end, up 3.5 basis points on the 2-year to 4.24. Meanwhile, the dollar strengthening against everything in G10 this morning. The Bloomberg Dollar Index up about 0.6%, while crude, after a 3-day winning streak, is down just a touch. WTI down about 0.3%. We're trading right around $77 a barrel, Anna.
Let's have a look at the European map then, Kaylee, and it looks red. It's really factoring in some of the nervousness around the Fed story as we wait for the central bank narrative to shift from the United States into here in Europe. But we have extensive selling really across European equity markets, in particular in Paris and in Frankfurt, where we're down by more than 1.2% in both cases. Kaylee, you had the oil price, the WTI price on your board. I picked the Brent price because there's been a little bit of movement there, and we're actually up at slightly more elevated levels. Let's have a look at where we are on Brent, 82.47. So we're coming down from yesterday's close, but we have in the most recent sessions been making gains back up towards that $80 a barrel mark. We're back over that now, so 82.47. And Goldman Sachs out with some really interesting research. They expect commodity prices in general to increase next year by more than 40%. Now put that in your inflation models, put that in your expectations about where inflation and the Fed and other central banks go. Talking of central banks, we're on to a host of European ones today. We've heard from one, yet to hear from another two. So let's start with the SNB. The Swiss National Bank increasing interest rates as expected, 50 basis points up to 1%. So far, so simple. Is this the weakness that we're seeing then in the Swiss franc? Is this really to do with what they did at the central bank there? They're talking about their willingness to go further and their willingness to intervene in FX markets, or is it to do with the strength of the dollar that we've seen post-Fed? Because that seems to be part of the narrative in the pound and also the euro. We wait to hear from the Bank of England and the ECB later on today, but we've got a stronger dollar, so we have a weaker pound down 0.7%, and a weaker euro down 0.6%. 123.36. We have come a long way back, Kaylee, from those days down at 103 at the depths of the post-September mini-budget turmoil. So we've come a long way. Will we see a four-way split at the Bank of England and on the ECB? The big question is around QT and what they signal there. More details on that coming up.
Yeah, still ahead, which I guess means that the year wasn't actually over yesterday, as we all thought it might be after the Federal Reserve decision, because we do have more central banks on deck this morning, as Anna mentioned, the ECB and the BOE both making their last rate decisions of the year. So on that note, let's get to our team coverage this morning. We have Bloomberg's Valerie Teitel on the Fed, Maria Tadeo is in Frankfurt on the ECB, and Lizzie Burden is covering the Bank of England. Let's start, though, with the backwards look at the Fed, the U.S. Central Bank hiking as expected by 50 basis points. Here's what Chairman Powell had to say about next year.
I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
So let's get over to Valerie Teitel, our markets reporter, to unpack Powell's comments, and maybe not just Powell's comments, Valerie, but the way the market reacted to them.
Yeah, Kaylee, clearly I think the market expected some kind of a nod to Tuesday's CPI data, and we really didn't get that. The 2023 dot, which is most of us view as the terminal rate, was above 5% at 5.1. Some people thought after Tuesday, maybe that could be 4.8, maybe it could be sub 5. And he repeated this word that ongoing rate increases are likely appropriate. To me, and I think most market participants, that means a pause in March is a little bit off the table for now. And again, he reiterated substantially more evidence of lower inflation is needed. After this opening statement, attention quickly went to the economic projections, where they nearly halved their growth projection for 2023 to 0.5% of real GDP, and the unemployment rate for 2023 also ticked up. 4.6% is what they're projecting. We know that unemployment at the moment is running at a 50-year low in the U.S. at 3.7%. Powell is clearly trying to communicate that we need some slack in the labor market. And why is that? He repeated again, core services inflation. The biggest input into that is wages. And with wage growth running at 5%, that does not equal core PCE going back to their 2% target. He did end the press conference on a bit more of a dovish note. He basically repeated some things like, we are close to being sufficiently restrictive. And the size of the February hike is going to depend on the data. He's going to leave it a bit open that we might see another step down to 25 basis points in February, but that really depends on the next CPI print, which we get on January 14th.
Okay, seems a long way off, doesn't it, Valerie Teitel? Thank you very much. Well, not much in it for the Doves then when it comes to the Fed meeting, as Valerie was setting out there. What lies ahead then from these European central banks? Let's get to Bloomberg's Europe correspondent, Maria Tadeo, who is in Frankfurt for us. Maria, the Fed went for 50 basis points. The expectation is that the ECB does the same, even if the story around that is a little different.
Yes, Anna, and allow me some time because there's a lot to go through today here in this meeting in Frankfurt. On the rate hike, yes, the mood is this inclination towards 50 basis points today to be announced by Madame Lagarde. Overall, that would take the deposit rate to 2%, and you're looking at 250 basis points total up on the year, the fastest on record for the European Central Bank, if that is announced and confirmed. Then on top of that, we will get an updated projections on the GDP front. Remember, there's this perennial question of will there be a recession or not, and what type of recession? And then, of course, the inflation projections. That is the key to me. What is the outlook over the medium term, and when does inflation peak in the eyes of the European Central Bank? And of course, when it comes to the press conference, all eyes on QT. Remember, she had promised she would lay out, quote, the principles of QT, but that means a lot, but it can also mean very little. It will depend on the kind of detail that she wants to provide to markets. Of course, they want to know the format and the timing, but again, there's a lot of question marks around whether Christine Lagarde will want to go into specifics or actually give herself some wiggle room here, considering, by the way, the amount of uncertainty still to play going into 2023.
Okay, QT and the extent of the slowdown in Europe in focus then at the ECB. Maria Tadeo reporting there from Frankfurt. Let's pivot from the ECB onto the Bank of England story. And the BOE is also expected to slow the pace of interest rates today. Another case of stepping down from 75 to 50. Bloomberg's UK correspondent Lizzie Burden has the details for us. Lizzie, investors and economists are expecting another 50 basis points hike. Something is catching amongst these global central banks. What else are we looking out for today, though?
Well, Anna, as you hinted, what I think is going to be really interesting today is the vote split, because for the first time in the bank's independent history, we might get a four-way split. At least that's what Nomura, JP Morgan, Bank of America have all said could happen. Something between 75, 50, 25 and no hike at all. And that's because, on the one hand, you've still got inflation in double digits, proving stubbornly, persistently high. But on the other hand, you've got doves on the committee who are very worried about a big hike taking effect in the heart of a recession. So some would call it chaos. Others would say, thankfully, there isn't groupthink at the Bank of England. The other thing that I'm looking out for today is the guidance, because remember, at the last meeting, the bank pushed back bluntly against the market curve, the future path for rates. And if it doesn't do that today, if it doesn't even talk about the market curve, the markets might interpret it as an endorsement. But the bank has said it doesn't want to provide a running commentary. That was a one-off. So this is going to be a case of threading the needle, but they don't call it Threadneedle Street for nothing.
All right, Lizzie Burden, thank you so much. Looking forward to your coverage on the Bank of England throughout the day. Meanwhile, another story we have our eye on this morning, ex-central banks. Elon Musk has sold another block of Tesla shares worth almost $3.6 billion. An SEC filing shows the EV maker's CEO unloaded at least 22 million shares. It's set to put further downward pressure on Tesla stock, which has plunged 55% this year. Craig Trudell, Bloomberg Global Autos editor, is joining us now with more. So, Craig, of course, this is not the first big unloading of Tesla stock we've seen Elon Musk execute this year. Sales are now, what, close to the $40 billion mark? What's behind this latest one?
That's right. It's really going to be interesting to see whether Musk, we know that he sort of lives online, lives on Twitter, the company that he just acquired in the last 6 weeks or so, whether he starts to address where exactly this money is going to go. As you mentioned, quite a bit of money that he's cashed in here, almost $40 billion since late last year. Obviously, lately, the concern here is just how much of this is, going to Twitter and how exactly he's going to put it to use. Does he try to take out some of the high interest debt that he layered onto the company to acquire it? That obviously is a burden that is going to be really difficult for Twitter to handle, given the challenges that it's having with advertisers and the problems that he's having trying to kind of plug that hole with subscription revenue. Obviously, he had to pull back on Twitter Blue for a while after these sort of imposter accounts sort of undercut his efforts to start charging people for verification. So whether or not he sort of weighs in, he's assured people several times now that he's done selling. And so I think, there may be some reluctance to sort of take him at his word going forward, given the several times he's sold since then.
Right, yeah, happened a few times. Good morning to you, Craig. So thinking about the broader auto sector, we got auto sales data out from Europe this morning. We've heard from VW in that context. The Volkswagen CFO actually speaking to Bloomberg TV, Arno Antlitz, sees a rocky road ahead for the industry. He was speaking to us earlier. Let's listen to what he had to say.
2023 might be even more challenging than 2022. We see the economy weakening, we see interest rates going up, we see inflation and the increased competition. So it will be more difficult to pass on some of the headwinds in terms of prices. We have to increase our work on the cost side, work on fixed costs, work on productivity in order to compensate for some of these effects.
The CFO of the German car company VW there. And Craig, this is really interesting, isn't it? As we go from 22 into 2023, here's a European car maker saying, actually, the challenges next year are going to get bigger. And we saw this sort of across the European story with those car production numbers that we got this morning. Yes, order books are full right now, but there's a lot of nervousness about inflation.
Absolutely. And we're going to go very quickly from problems with supply to perhaps problems with demand, where, there is an awful lot of purchases that presumably are sort of, kind of left over from the fact that companies like Volkswagen have not been able to make enough cars to keep up with demand. But the problem is, just how much longer that is going to last because of higher interest rates, because of consumer confidence waning, because of here in Europe, the energy crisis. And that's something that even, to go back to Tesla, you've heard even Elon Musk talk about, those challenges along with the issues in China. And so, this is a case of an industry that, very much has had a problem of not being able to make enough to perhaps now, once they finally can make enough because of the chip shortage easing, now on the other side of that, they may have problems with the consumer.
Yeah, really interesting to watch the demand story because, yes, there's the cyclicality, and that's what we're talking about here. There's also the structural shift toward EVs, which no doubt will be to some degree supportive. Craig, thank you very much. Bloomberg's Craig Chadell to talk about the car sector. Now, coming up on the program, we'll pivot back to the central banking story. We'll get response to the Fed. Danielle De Martino Booth joins us, Quill Intelligence CEO and Chief Strategist, a great voice to have post-Fed. What does she make of the market moves and the extent to which the market might be fighting the Fed? Is that wise? And live from the Forum of the Americas in Paris, we will be hearing from the ENGIE chairman, that is Jean-Pierre Clamadieu. There is a lot going on in the European energy space right now, so a good conversation to bring you. Plus, on the ECB and the Bank of England, Josie Dent joins us, managing economist at the Centre for Economics and Business Research, the CEBR. She'll give us the European perspective on rate hikes. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
His forecast now is for GDP to be lowered to 0.5 for next year.
If anything, 0.5% is probably overly optimistic.
It is quite a hawkish tone from the Fed, more hawkish than the markets had been expecting.
What that tells you is he's not forecasting recession, but that's as close to a recession as they ever get.
They have to slow the economy down sufficiently to generate enough slack in the labor market so wage trends come down to be consistent with 2% inflation.
We've had a kind of a back and forth and a little bit of debate of, whether we've seen the bottom in equity markets. I think the jury is still out, and I think a more cautious stance is still warranted.
The key components are still quite sticky, and that would suggest more tightening is needed.
That was some of our guests here on Bloomberg Television reacting to the Fed's decision to hike 50 basis points and Chairman Powell's remarks. Joining us now for her reaction is Danielle DiMartino-Booth, Quill Intelligence CEO and Chief Strategist. Danielle, great to see you again. You were also here after the last Fed meeting and press conference, and you told us that Fed Chairman Powell was like a one-man dot plot at the podium that day. We now have a dot plot, and it reflects maybe a bit more consensus on the FOMC. They all seem to be sending the same message. Is the market receiving it properly?
I think so, and I think that what really spooked the markets yesterday was the consistency. In fact, Chair Powell was asked specifically, were those dot plots turned in on Friday at close of business? Because Friday close of business is typically when they have to be submitted. However, they can be altered up to the night of the first day of the meeting, as in Tuesday night after the CPI print came out, and they still held. And I think that was really what got the markets, as well as the fact that as far out as the dot plot went, you saw a terminal rate of 2.5%. In other words, we're not going to maybe ever visit the zero bound again.
And you talk about the questions that Chairman Powell received at the press conference. The very first one was about financial conditions that have gotten easier. He didn't push back as aggressively as some thought he might have been able to. Was that a mistake?
No, I really don't think so. I kind of felt watching those first few questions that the reporters were trying to bait him and see if they couldn't get the angry Jay Powell to come out. And I think that in the end, what was even a little bit more disturbing was how calm and cool and collected he was in maintaining his narrative. And he's like, we don't need to concentrate as much on the size of the rate hikes going forward as much as the fact that we're going to keep them there for a long time. The implicit message there is that we're going to keep shrinking that balance sheet month after month after month. That is a form of tightening.
Right, Danielle, that's really interesting, isn't it? The role that QT could play, as we get towards the end of the hiking cycle, but then also during a pause, and then what happens to it as we cut. You said something interesting, though. You talked about how we are not going back to the zero bound ever again, or at least maybe it's starting to look that way. And we've had quite a few conversations this week with investors and analysts and economists really rethinking their medium-term inflation expectations for a host of reasons to do with sustainability, to do with, and what that does to commodity prices, of course, to do with geopolitics and other things, aging, for example. So where do you fall in on that? Where is the medium-term outlook for inflation?
So I think that there is going to be a higher sustained level. The one aspect you didn't mention, and you mentioned a lot of great ones, is reshoring. And if you look at company conference calls, there has been quite a bit of blanket discussion of bringing manufacturing back onshore. I don't think that this is a phenomenon that's unique to the United States, but there's something implicit in not looking for the least expensive labor around the world to make things. And that implies that you're going to have a higher level of inflation than you would otherwise.
And so what does that do to rates then, Danielle? What kind of level of rates do we settle at, if that's even possible, as we go through 2023 and into 24?
Well, what was fascinating was that they actually had their core PCE forecast coming in below where they saw the Fed funds rate at the end of 2023. That's not really how the world works. You're not supposed to have short-term borrowing costs above where you perceive inflation as falling to. I'm actually not of the opinion, though, that there's as much slack in the labor market as what is being advertised. Kayla and I were talking just before we came on the air about a website that tracks all the closures of companies in the United States. For the month of December, we've already surpassed that of the month of November and the month of October. So there is indeed damage being wreaked with this lag effect that I think is coming in more quickly than the long and variable 18 to 24 months that we've grown accustomed to. I think that the magnitude of these rate hikes, 425 basis points since March, I think that tells us that the lags are going to be shorter.
That context is so important considering where we were just 9 months ago
Right,
and how
of
far
course.
we have come.
This is the fastest since 1981.
So if we're moving that fast, technically when you move faster, in theory, you can break things easier. I mean, where is the soft landing argument now?
I don't, so another one of your guests was saying this is about as close as we possibly get to the Fed acknowledging recession. I mean, 0.5% is a rounding error. The National Bureau of Economic Research that scores recessions, in fact, we're about $40 billion away, give or take, from the NBER saying that recession started in January of 2022 in a $23 trillion economy. So we could actually already be there. And you know what? The Fed's full of economists, and they know this. So they're aware of the policy that's being undertaken despite what's happening. Jay Powell stood at the podium yesterday and he said, we know that housing prices are going to come down next year. Yeah. We're going to keep going anyways.
They're going to tolerate that pain, or at least so they
Right.
say. We'll see if they can follow through on that. Danielle DiMartino Booth of Quill Intelligence, great to see you as always.
Likewise. Happy holidays.
Thank you so much, and same to you. All right, now let's keep you up to date with other news from around the world to watch with the first word. Executives at failed crypto exchange FTX used a mysterious account to help hide ballooning debts of its sister trading firm, Alameda Research. That's according to internal documents reviewed by Bloomberg News. The account bore the name of FTX's engineering director. In China, economic activity weakened last month before the government abruptly dropped its COVID-0 policy. Retail sales and home sales declined, while industrial output and investment slowed sharply. Meanwhile, unemployment rose, notably for the country's most valuable workers. Disruptions are likely to grow as COVID infections surge. In Peru, violent protests have led the government to declare a state of emergency and suspend basic rights for 30 days. New President Dina Boluarte is trying to establish her authority and restore order. At least 7 people have died in clashes involving demonstrators demanding the release of former President Pedro Castillo. He was arrested after trying to dissolve Congress. And BlackRock is one of the targets as Florida escalates its war against asset managers that offer environmental, social, and governance investments. The state's chief financial officer says more state money will be pulled from BlackRock, saying that CEO Larry Fink, quote, really did it to himself. And Anna, this has been so interesting to watch evolve as there was such a push toward ESG investments, and now you're seeing some real political pushback against that.
Yeah, and I thought really interesting to see that Goldman Sachs research today talking about the way that they think that commodities are going to be higher in price next year by more than 40%, partly because of a lack of investment, and it's some of that ESG impulse that's led to a lack of investment in the sector, in the views of some. HSBC just announcing this morning that they are no longer going to fund any new oil and gas exploration sites, which is an interesting one from such a large bank globally. Coming up on this program, we'll continue the theme of energy, in fact. We'll be live from the Forum of the Americas in Paris. Engie's chairman will join us. That conversation about the European energy space. This is Bloomberg.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which is, I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fed Chair Jerome Powell sees interest rates being higher for longer, but investors see the outlook for next year a little differently. The Bank of England and the European Central Bank are out with their own rate decisions today. Both are likely to slow the pace of rate hikes. And Elon Musk unloads Tesla stock for the fourth time this year. He sells another $3.6 billion worth of shares. I'm Anna Edwards in London with Kaylee Lines in New York. Matt Miller is off today, and it seems maybe the market, the way the markets are performing, Kaylee, suggesting that maybe some people had slightly more dovish expectations of the Fed than actually materialized yesterday.
Yeah, I think that's right, Anna. Overall, we'd heard people saying that the statement and the press conference were screaming hawkishness, yet the market yesterday at least seemed to cling to any individual, perhaps perceived dovish thing that they could, with stocks closing off of session lows yesterday after hearing from Chairman Powell. What's interesting, though, is that losses are accelerating as the future in session grows older this morning after. Right now, S&P 500 futures down about 1.1%, so maybe that hawkishness really is sinking in. And after yields moved slightly lower yesterday, they now are heading back up. The two-year yield up about 3.5 basis points at the moment. 424.46 is where we trade. While the dollar is gaining strength against all G10 currencies, the Bloomberg Dollar Index stronger by about 0.6%, and crude essentially flat on the day, $77 a barrel, where we trade at the moment. As for some individual stocks to watch, Anna, you mentioned this, another Tesla share sale from Elon Musk. This one worth about $3.6 billion. His total share sales over the last 12 months now approaching $40 billion. So that is dragging on the stock this morning. It's down about 2.8%. And remember, already it is down 55% on the year. Is that mostly concern about Elon Musk's acquisition of Twitter and distractions from that? Is that actually having to do with fundamentals of the company and weakness in demand in China? Maybe both at the same time. You're seeing other weakness in tech stocks as well. Apple down about 1.3%, and NVIDIA is down 2.5%. In addition to the broader drag on large cap technology we're seeing today, it also was initiated with coverage at HSBC with a reduced rating. The analysts there citing weak demand in the chip space, and then it's also analyst action weighing on Western Digital today. It was downgraded at Goldman Sachs, so that stock down 4.5% before the bell, Anna.
Okay, a lot to focus on in the pre-market movers. This is the European story right now. It looks weaker, down by 1.2% on the Stocks Europe 600. You mentioned weakness in tech stocks, weakness almost across the board, it seems, for European equity markets. We have a lot of central banks in focus today. Let's start with the one we've heard from already, the Swiss National Bank coming through with a 50 basis point hike, as expected, up to 1.1% on their rates. We see weakness in the currency, but is that more to do with dollar strength? Because dollar strength seems to be a theme across the board. We have the dollar stronger against the pound down 0.7%. ahead. On the day, we hear from the Bank of England. Will we get a four-way split there in terms of that decision? And we'll also hear from the ECB with the euro down 0.6% against the US dollar. A focus there, Kayleigh, very much on quantitative tightening and whether we get any further details around that story. But broadly expecting a follow-on from the Fed, 50 basis points from both of these central banks.
Okay, Anna, well, clearly central banks are a big focus today, but there also is another event ongoing in Paris, where major international shareholders are gathering at the Forum of the Americas. So let's get over to there now. Bloomberg's Danny Berger is there, and she is joined with the chairman of ENGIE. Danny.
Kayleigh, thank you so much. That's right. Chairman of ENGIE with me now is Jean-Pierre Clamadieu. Thank you so much for joining. It's great to see you in a very cold Paris. I know I've been complaining about it all morning to you, but this is part of the conversation, right? It is finally cold here in Europe. It's been mild. We avoided perhaps the worst of an energy crisis. The IEA Fatty Birol says the worst is yet to come. Europe risks being complacent. Is he right? Does Europe risk being complacent?
I think we always risk to be complacent, and I think it's very good to hear a voice like Fatty Birol saying us, be careful guys, the challenges are yet to come. I think what happened this week is very good news, because we had a pretty severe cold spell in the northern part of France and part of Europe, and we've been able to go without any issue. Gas infrastructure is working very well. We have gas flowing in a very optimal way to make sure that end consumers will receive what they expect. And on the electricity side, where we have a bit of a challenge in France, you know, due to the situation with our nuclear power plants, we've been able also to feed customers, and there was no disruption at all.
So we've survived the stress
We've survived
test.
This week,
yes.
And I think it's a good sign for the rest of the winter.
What needs to happen to make sure the rest of the winter and winter 23 can continue in that path?
Well, it's a bit different on electricity and gas. On electricity, what we need is to make sure that EDF, French utility, will be able to bring the majority of its nuclear plants online. They have a plan to go back to a normal level of operation. Their CEO has confirmed yesterday that he was optimistic that they will be able to achieve that. On gas side, we are seeing a significant reduction in consumption, 10% more or less, and a bit more in some countries. That's good news. It shows that people are listening to the messages regarding the need for energy conservation. We need to see LNG continuing to flow, and that's we've been able to reorganize our access to gas in the last 6 months.
I want to ask that in ENGIE specifically, in terms of being able to reorganize that. Have you been able, I know you've had some contracts with U.S. suppliers, for example, have you been able to completely replace the Russian supply?
Yes, we have completely, at ENGIE, if you take the ENGIE situation, we have completely replaced Russian gas, thanks to more gas coming from Norway, more gas coming from the US, and a few other countries helping us rebalance our contract portfolio.
But is that sustainable, especially as China starts to come back on the map? I mean, this is a competitive market.
For ENGIE, I think we are pretty confident. When I look at the commitment we have with our customers and the way we are able to manage our contract, I think we'll be able to go through next winter. But the challenge is for Europe as a whole. Once again, we have a situation which gives us today the view that we will be able to go through next winter, despite the fact that there won't be any more Russian gas or a very limited flow of Russian gas. Now, we need to make sure we continue to save energy, one, and we need to make sure we continue to access LNG. If China was to pick, if China's economic activity was to pick up, it would be a point of attention. But even in the past few days after the announcement that the COVID restriction would be lifted, we have not seen any tension on the LNG market. So far, so good. In terms of access to energy, the big challenge for Europe, as you know, are the prices.
Yes, that's the other piece of the puzzle, the price cap debate, which 300 kilometers from us, Brussels unable to solve that, still can't reach an agreement. The initial drafts, of course, have the price cap so high that it likely won't be triggered, which Germany, of course, likes. Other countries disagree. What do you think the solution should be?
We've been advocating for a gas cap at ENGIE, and we've been advocating because we've seen extreme prices. I mean, gas prices in Europe have been between 10 and 20 euro per megawatt hour for a decade. We've seen prices as high as 300 euro per megawatt hour at the end of August. This was not the fact that there was a competition between Asia or Europe to access to gas. It was a huge risk premium, which has no reason to be fair. So our view is that a price cap would help avoid these types of situations. Obviously, there need to be another mechanism to ensure that we would be able to import the LNG that we need. Am I optimistic that a solution will appear today? I used to be an optimistic person. In this case, I think the debate will be very complex, and I'm not sure that we will end up with something which, at the end of the day, will have an impact.
Are you worried about European unity in general as these debates go on?
I think what we've seen on the energy field is not reassuring. We've seen the beginning of a fragmentation of the European landscape, the decision which was taken about the way electricity producers should be taxed. It was a very weak position from Brussels, saying this is the system I suggest, but each country can adjust it. So we have very different situation in countries where energy operates, France, Belgium, Italy. Each country seems to try to design its own scheme. It's not good. And I hope that the next discussion on the electricity market design will continue to help make sure that we have a European system.
But what happens if we don't, though? What happens if this continues on?
European system is very powerful. If we are able to go through this week without major issues in France, it's because we're able to import electricity. At the same time, we are exporting gas to Germany. So the European unity is a very key element to make sure that we can all together go through this energy crisis. And if we are not able to continue this way, there will be sub-optimization. There will be in a suboptimal system. And this would create issues regarding security of supply and probably will lead to higher prices.
Well, part of the issue for Europe is that just the economy is built off of cheap energy sources, which is Russia. I mean, can it stay competitive without Russian energy, without that cheap source?
It's very challenging. Midterm, the solution is very simple. Let's move massively towards renewable energy. That's really the direction of travel for Europe, with nuclear in countries like France, where nuclear enjoy political support. Short term, there's a need for a number of adjustments, and it's where to make sure that prices stay reasonable. They will always be much higher than in the US, and it's where we would need the EU to react and act as a European, showing European leadership. And it's an area where we are probably lacking a bit of this leadership.
Well, speaking of the U.S., of course, the U.S. enacted the Inflation Reduction Act. Part of this drew the ire of Europe because it does give subsidies to green manufacturers in Europe, perhaps preferring those over Europe. What should Europe's answer be to that?
First, it would be a united European answer. It can be country by country. Second, we have to realize what's happening in the US. US is creating, in a number of areas, great opportunities for people to invest. Europe is still very much in a regulation, let's develop the regulation mode. We need to incentivize industries to continue to produce and develop innovation in Europe. And that's a big challenge that we need to face again all together.
All right, Jean-Pierre, thank you so much for joining. Really appreciate your time. And Anna, with that, I'll throw it back to you. Jean-Pierre Clamadieu there, the chair of Energy. NG, it might be ECB day, but it is below freezing in Paris. Energy is certainly top of mind.
Danny, thank you very much for braving the cold for us in Paris. Well, if it's any consolation, it's pretty cold here in London, where you normally reside, Danny. So thank you, Danny Berger, there on the road in Paris. Danny will have more interviews from the Forum of the Americas, including the CEOs of Societe Generale and Man Group. So look out for those over coming days. Coming up on this program, we will get back to the central bank narratives that Danny was just referencing. Josie Dent joins us, managing economist at the Centre for Economics and Business Research, the CEBR here in the UK, but talking about the Bank of England and the ECB, what to expect from those hikes. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Let's move on to the central banks that are in focus today, pushing ahead to the Bank of England and the ECB with their rate decisions due. Both are poised to slow the recent pace of hikes, both to step down from 75 to 50. That's the market's expectation, at least. Joining us now is Josie Dent, Managing Economist at the Centre for Economics and Business Research. Let's start with the Bank of England then, Josie. Very nice to have you with us. There is the possibility we get a four-way split in the voting. Such is the uncertainty around the UK economic outlook right now, the cost of living crisis, the inflation pressures, all of that coming together to mean that we could see policymakers voting for very different things. What's your expectation?
So we are in line with consensus expectations that overall there will be a 50 basis point rise from the Bank of England today. But it's a really tricky path, a narrow path that policymakers have to follow between trying to control this very high inflation we have at 10.7% in November in the UK, but then also the fact that we're probably in a recession right now after a 0.2% contraction in Q3, and we're forecasting 3 more quarters of contraction over the coming quarters into the first half of next year. And so while, raising interest rates will help control that inflation, hopefully bring down some spending, reduce demand, and therefore bring down the rate of inflation, policymakers do fear the recessionary impacts of that. While there is already expected to be a recession, they could deepen it with too harsh a policy. Some might vote today for a 75 basis point rise, some might vote for a smaller rise, and it's really to do with those preferences in terms of should we try and reduce inflation or should we try and limit the size of the recession? Yeah. So those are the key questions that they're thinking about.
Yes, and how concerned are you about the exposure of UK households to higher interest rates and mortgage costs? Because the stability review that we got from the Bank of England earlier on this week referenced this, gave us some size and scope around the number of households, the percentage of the population even, that will be exposed to these higher rates in their mortgage costs in the few years ahead.
Exactly. So in the UK, it's pretty standard to have around a 2-year fix on your mortgage. But then with interest rates expected to remain high for a considerable period over the coming year or two, the majority of households who are currently on a fixed rate mortgage will come off that in the coming years. And then will have to remortgage or will face a higher variable rate on their interest rate on their mortgage. And of course, housing costs are one of the biggest costs that anyone pays for in their lifetime, be it rent or your mortgage. And with those going up, then this is one of the biggest factors that's going to drive the cost of living crisis over the next year. Of course, we're seeing food prices rise, energy prices rise, and those have been placing considerable impacts on households. But as more and more households come off their fixed rate mortgage and are facing higher mortgage costs, this will have impacts on the housing market and massive impacts on the amount people can afford they might have to cut back in other areas in order to afford their mortgage. And so this is a significant impact that's driving this recession. The fact that if people have to spend all their money on their higher mortgage, then they won't be able to spend in other areas. So it's a big cause of concern and a big factor that's probably going to be driving this recession.
Well, Josie, you mentioned so many factors that are putting pressure on households in the UK, including energy. And I'm wondering, as Danny Berger was just talking about this with the chairman of ENGIE, the reopening of China, which in theory is going to drive more demand for energy and make that even more competitive. How much upside risk to inflation does that pose, not just in the UK, but in Europe as well?
Yeah, I mean, so in the UK, households, in terms of their energy bills that they pay for electricity and gas, are somewhat now protected by the Energy Price Guarantee Scheme. But of course, you know, there are still so many pressures you face in terms of prices at the pump, which have been falling recently and have caused this slightly lower inflation that we saw in November. But at some point, you know, the Energy Price Guarantee Scheme is going to end and people will face higher pressures at the pump. And so with more demand from China, that higher demand equals higher prices on the open markets, that could increase the price of energy and have big impacts, both in terms of consumers who are facing across Europe the impact of higher energy prices on their household bills. Big cost for the UK government in terms of guaranteeing prices when they're rising. And so knock-on impacts on UK debt. Yeah. And of course, industry, it has a big impact on in terms of, you know, they are incredibly energy intensive businesses when you look at construction and manufacturing businesses. Right. And so then that might drive more inflation because businesses will have to pass on those higher costs to consumers. So there is a considerable upside risk. We are forecasting inflation to slow both across the Eurozone and the UK next year, but it could slow at a weaker rate if energy prices remain high, because they are one of the biggest forces that drive inflation.
Okay, so Josie, let's zero in on Europe and more specifically the ECB, the other central bank that has to make a decision today. If 50 basis points is baked in, maybe more of the question surrounds QT. What is your expectation there?
So yeah, as you mentioned, that we are expecting a 50 basis point rise, and the ECB has similar problems to the Bank of England in terms of the worry about a recession. We're forecasting just 0.1% GDP growth for the Eurozone as a whole next year, and you know, whether or not they have to tighten in terms of QT alongside this basis point hike of around probably 50 basis points to the main interest rates. You know, as they try and get a hold on inflation, it is a big question because inflation in the Eurozone is slow in November, but it's still at 10%, which is 5 times you know, their target rate of roughly 2%. And so, you know, the methods that they use to get a control on inflation include, of course, not just raising interest rates, but also, you know, considering should they start selling the vast quantity of bonds that they built up over the course of the pandemic to support the economy, to support businesses. And so we may well start to see more of tightening there.
Josie, thank you. Yes, inflation really varied across the Eurozone as well. Some areas in single digits and some up as high as the low 20% level. Josie Dent, thank you very much for joining us from the Centre for Economics and Business Research, talking there about the Bank of England and the ECB. And stay with Bloomberg for full coverage of both of those central bank decisions. We will bring you all that you need to know when following the central bank decisions. There is Christine Lagarde and the details of the ECB decision. We'll also, of course, bring you what is the latest from the Bank of England. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards in London. Matt Miller is off today. So let's take a look at what he is missing, what's coming up in the day ahead. We will continue our focus on this massive week for central banks. We're going to get the BOE rate decision at 7 a.m. Eastern Time. 50 basis points is what is expected. The question is, how much disagreement is there among the members of the BOE? Then that's followed up by the ECB decision at 8 a.m. Eastern Time. Again, 50 basis points is what is expected. The question is surrounding quantitative tightening. Then we'll get some economic data here in the U.S. as well, including initial jobless claims, retail sales, and industrial production data. So as much as we all might want it to be, Anna, the year definitely is not over. We have, at the very least, one more big day to get through.
Yeah, one more big day to get through in terms of those central bank decisions. Interesting on that U.S. industrial production data, though. I think there's an expectation that manufacturing output slows a little bit, but there's strength in vehicles and parts. And it takes me back to the start of the program where we were talking about strength in the auto sector. Order books still looking full, but concern about demand. And it's an interesting one, isn't it? What kind of macro signals we're getting from that sector? Are they accurate macro signals? I suppose if we're looking for broader macro signals, I do wonder whether we're done after this week, Kaylee, or whether we still have to pay attention next week. I mean, are we done until, what is it, the jobs report on January the 6th? Can we kind of come back then?
Yeah, maybe. Although I will say, Anna's going to be here in New York next week, so I do hope we have some stuff to talk about for your visit to the U.S. At the very least, that alone will be newsworthy. We're all looking forward to that very much. So, Anna, definitely an interesting day in terms of the macro signals. We're going to get more in the next few hours, and of course, they're going to be taking us through all of that on surveillance.
Yeah, absolutely. And really interesting to see if we get that four-way split at the Bank of England. I mean, that's not the base expectation. I spoke to analysts earlier who were saying, no, it could still be 7-2. That's the division between those voting for that hike and those voting for something different. But we will watch and see how the 9 members of the MPC fall into line or don't when it comes to this rate hike that is expected today. More surveillance is ahead. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
See us considering rate cuts until the committee is confident that inflation is moving down to 2%.
They have to have slowed the economy down sufficiently to generate enough slack in the labor market so wage trends come down to be consistent with 2% inflation.
It doesn't want the economy to pick up momentum again and prolong the inflation problem.
We're going to see weaker growth data for sure, and then we're all going to look at the Fed and they'll say they're resolute.
We're going to continue to see this tug of war between the data and the Fed really throughout much of next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The year is over. Go home. Grandma's already packed her bags. She goes skiing or something.
Do you think Chairman
put out there?
You think Chairman Powell watches the TNT Home Balloon? You know, where they play Home Alone for like 28 hours?
I think he watches Hallmark Christmas movies.
He probably does. It felt like one yesterday.
Seemed distracted yesterday. From New York City this morning. Good morning to you all. On TV and radio, this is Bloomberg Surveillance. Equity futures down about a percentage point. Thompson pushback on the South Side yesterday after that news conference from Chairman Powell.
I thought acute notes for what was less than an acute press conference. I thought Colby Smith tried to get it started. He evaded her question. Michael McKee saved the day. Steve Leisman started strong, to be fair. And everybody else, it was just about where are the dots. I was bored. Ellen Zentner, Morgan Stanley, difficult to follow the logic. That's maybe the smartest single sentence.
Tom Porcelli joined in. He said that some of their economic projections, Lisa, are just head scratchers. What did you make of that?
Well, and that really goes to what Bill Dudley was saying, that still, even though they're bringing down the expectation for growth, it's still improbable. They didn't really highlight how deep the recession would have to be given their what they're expecting with respect to a 5.1% Fed funds rate at the end of next year.
The continuum from going from Stanley Fischer's ultra accommodative in the financial crisis out to where we were clearly accommodative. We're not there now. And the tension yesterday, and almost John, the lethargy in the meeting, I mean, everybody's watched the soccer game, but the lethargy in the meeting is primarily because we're here. We are at neutrality. And dare I say, and what moved the market later is perhaps we're on the edge of restrictive.
Not sufficiently restrictive. They were his words yesterday from Chairman Powell at that news conference. We are almost sufficiently restrictive, but we're not there yet. That's what he said to Mike McKee.
Which wasn't perhaps the message that he wanted to send. Let's just be very clear, because almost restrictive goes against what he said earlier in the press conference where he says we have quite a ways to go. Almost there doesn't sound like quite a ways to go. So the market basically came out. They were trying to sound hawkish. The market read this as, yeah, you're going to raise maybe once or twice more, 25 basis points next year. Then you're going to hold, then you start cutting by the end of next year. We got it. We got your number. And he was like, no. And he's, yeah.
You guys, I think, have been more critical than me. Steve Blitz at TS Lombard nails it. He says, are they losing control of the narrative?
Oh, sure, without a doubt.
Really, really an interesting.
They want to signal tight policy through 23.
Right.
This market wants to talk about rate cuts. Lisa's talked about that a million times. And if you want to sound hawkish, don't start talking. Don't even flirt with the idea of reassessing your inflation target. I mean, you can't say on the one hand, we're not looking at that right now, but you know what? I've got one further thing to say. Maybe a longer-term project in our future. I mean, why even go there? Why say it?
Exactly. And you could say, well, this is just theoretical mumbo-jumbo. Bill Ackman coming out, talking just about this and talking about how the likelihood of this reexamination is significant and that there could be a realistic kind of 3% target for inflation rates that would allow businesses to operate.
Can I give you an anecdote?
Of course you can.
My driver today, the Bentley was down, so I took Lyft or Uber or whatever. And Kenny was great. He said, it's never been like this. He says the Christmas party circuit this year in New York, he says it's nuts. He's been doing this for years. And he says, it's like, you know, Delta Air and United we were talking about yesterday. There's a fervor out there that pushes against 0.5% GDP.
Is that your gauge of the U.S. economy, taking Uber Super Black?
Yeah, you know, it's what, I'm sorry, it's cold out, John. It's like freezing. On a British basis, Lisa, this is cold.
You're just trying to wind him up.
Finally said it was freezing.
I know.
Walking to breakfast yesterday. Finally just acknowledged that it was cold.
It's almost cold.
And now he's going to mention the Dow literally every 5 minutes.
No doubt about it. So I'm going to start with the S&P. Equity futures are down a little more than 1% on the S&P 500. We've had a bigger move this morning than we've had yesterday. The S&P right now down by a full percentage point. Yields right now up by a basis point, 349. And in the FX market, euro dollar, just a weaker euro going into this ECB decision a little bit later. Lisa, euro dollar 106.13.
Yeah, Bank of England comes at 7 a.m. It is 50 basis point week. I mean, that's basically what we're hearing from everyone, although there's a different tone to 50 basis points from the U.S. versus England versus what we're getting from the ECB. 7 a.m. Bank of England, it was 8:15 a.m. we get the ECB rate decision. Again, 50 basis points is what's expected, followed by 8:45 8:45 a.m. I can't get it. Morning, night, whatever. With Christine Lagarde.
Good afternoon today.
Well, yeah, we're going to try. I am wondering whether a hawkish tilt causes the euro to gain or lose versus the dollar because of the concerns about the housing market, because of the concerns about the economic trajectory. At 8:30 a.m., we get a slew of U.S. data, including November retail sales and initial jobless claims. Yeah. Do we see more labor market weakness? That's what I'm trying to figure out.
Can I parse something here? John, explain. You're going over to England here in hours, literally. The Gulf Stream's waiting. Can you parse for us the hardship that Governor Bailey faces in the United Kingdom right now?
Well, it's not the hardship that he faces. It's the hardship that the British people face.
It's not like America. It's a lot worse, right?
It's a cost of living crisis, that's for sure.
Yeah, okay.
Inflation's eased from a 41-year high. That's the good news. The bad news is it's still very high, and this Bank of England is still forecasting a recession through much of next year, into 23 and beyond.
And ECB is a small matter of a war. I mean, I just don't think any of this is comparable this morning.
Any of these decisions, none of them are easy. And yes, we're getting a step down, but 50 basis points from the BOE, 50 basis points from the ECB. I never thought we'd be sitting here looking at the ECB, maybe hiking rates to 2.5%, 2.5%. It's just not where I thought we'd be in this cycle 2 years ago. And here we are staring down the barrel of not just a 50 basis point hike, but also some QT as well.
Do they do the dots? The ECB does the dots?
They don't do the dots like the Fed does. We will get some projections from Lagarde a little bit later, though, so look out for that. The chairman of the Federal Reserve trying to push back against rate cuts and the projections of those rate cuts through 23. Take a listen.
I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Do you believe him? Thanos Vambakidis joining us right now, the global head of G10 FX strategy at Bank of America. Thanos, let's start there. He's saying no cuts in 23. Do you think we get rate cuts in 23?
I do believe him, but the market does not. What he's telling us effectively is that it's quite likely that inflation next year will remain well above the 2% target. Indeed, in our projections, we have inflation in the US 4.4% next year, although lower than this year, again, far from their target. And this does not justify the Fed cutting rates next year, even if there is a recession. The market consensus, however, seems to be that as long as inflation is moving in the right direction, any signs of weakness in the labor market will be enough for the Fed to blink. Powell keeps giving the same message. The market does not believe him. The dollar has weakened in the meantime. The truth is that when we look at the data recently, inflation has turned, but there is evidence that it is sticky, and the labor market is surprisingly resilient. So far, I think there is no reason for the Fed to change its tone. They will remain hawkish.
Thanos, synthesize the Bank of America call, the research of your team, Mr. Gapin and all, in the last 12 hours, and then bring it over to the dollar. We've got to get out to February 1 and, dare I say, March 22nd next year. In a general statement, what is the action plan of the Bank of America?
Now, we believe that the market has run ahead of it. More than halfway there for our end-year euro-dollar forecast. We have it at the end of next year at 110. We're at 106. Dollar yen, we had it at 136, and we are there already. So we believe that early next year, the market will realize that inflation is sticky. It is falling, but much slower than the markets expect. The Fed remains hawkish. We also believe that we're going to see an equity market correction because equities are not pricing a recession. So we expect that early next year, the dollar actually will strengthen again. We may not see a new peak for the dollar, but we may go in terms of euro-dollar even back to parity. And then to have a more sustained move for the dollar down, we need to see core inflation low enough and unemployment high enough for the Fed to feel comfortable that they have this under control. And then we can argue that we go back to the dollar moving towards its equilibrium. We are not there yet, and it seems to us that the market has already priced most of what is expected to happen later in 2023.
Just quickly, Thanos, because we're bumping up here against the Bank of England decision, what's your expectation about how they're going to factor in the housing market in terms of trying to be hawkish, but also not destroy that economic bastion?
This has been a challenge for the Bank of England. That's why they are hiking, but they're apologizing. We expect 50 bips in this meeting, so a slower pace, but this is fully priced. They will continue pushing against aggressive market pricing looking forward. They are dealing with a stagflation scenario. They cannot afford to pause yet, given that inflation remains very high, although it has turned recently. But also they have to deal with financial stability concerns, the housing sector. So again, they will be delivering dovish hikes, as we say.
Thanos Varoufakis of Bank of America. Thanos, thank you. Dovish hikes, TK, you love that phrase, I know you do. Just want to check in on sterling, 123. And I just want to pause on this. We have had an almost 20% move on cable since the back end of September from the intraday lows of 103.50.
Rishi Sunak?
I think more broadly, we've had some dollar weakness, and I think we've finally got some policy stability after the uncertainty of September. But I don't think these are good times for the British economy by any stretch.
Well, and again, I go to the war, which I think has been underappreciated, and I dovetail in here what Chairman Powell faced with yesterday after just in 48 hours, Lufthansa of Germany, which has always been challenged, saying, you know, we're not challenged right now, it's pretty good. And then the blockbuster underplayed story this week, United's Boeing order, is a stunning statement on American technology and aviation.
United's order and Delta's outlook.
Yeah.
The airline business
this is
next year.
This is a different morning, folks. You got to stay with us to see this tension that we see with Bailey and then John onto the Lagarde presser.
We've got to acknowledge, Tom, that tech is having a very different experience. I think kind of tech recession, airline boom.
And profitability, too.
Two different economies right now.
Good. Are we here? When do you leave? You leave like at 10:02?
Maybe in 20 minutes.
Okay.
Equity futures right now.
Depends how we behave.
Down 1% on the S&P. The ECB and the Bank of England decision coming right up.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell wants to dispel the notion the central bank will back away from its fight to bring down inflation. Powell says the Fed has more work to do in raising interest rates. The Fed hiked rates by 50 basis points to the highest level since 2007. And Powell made it clear the Fed is not thinking about cutting them next year.
The Bank of England and the European Central Bank are delivering rate decisions today. They're expected to follow the Fed with their own half percentage point hikes. There are concerns that overly aggressive action to tame inflation might make a recession worse. In China, economic activity weakened last month before the government abruptly dropped its COVID-0 policy. Retail sales and home sales declined, while industrial output and investment slowed sharply. Meanwhile, unemployment rose, notably the country's most valuable workers. Disruptions are likely to grow as COVID infections surge. Executive at failed crypto exchange FTX used a mysterious account to help hide ballooning debts of its sister trading firm, Alameda Research. That's according to internal documents reviewed by Bloomberg News. The account bore the name of FTX's engineering director. And for the fourth time this year, Elon Musk has unloaded Tesla stock. The electric car maker's CEO sold almost $3.6 billion worth of shares this week. The stock has plunged 55% this year. Investors are concerned that Musk's $44 billion purchase of Twitter could have an impact on Tesla. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday only on Bloomberg. It's the ECB's last rate decision of the year. Bloomberg has you covered with breaking news from Frankfurt and Christine Lagarde's following press conference. Coverage starts today on Bloomberg, your global business authority.
The full effects of our rapid tightening so far are yet to be felt. Today, the FOMC raised our policy interest rate by a half percentage point. We continue to anticipate that ongoing increases will be appropriate. The labor market continues to be out of balance.
Fed Chair Jay Powell in the news conference yesterday after hiking interest rates by 50 basis points. Live from New York City. The price action. I have to say the price action this morning worse than yesterday. On the S&P, we're down by 0.9% on S&P 500 futures. Yesterday on the S&P, we were down by what? Just 0.6%. So we add to the losses this morning. In the bond market, yields are higher by about a basis point on a 10-year, 348.81. 2 hours away from an ECB decision, about 40 minutes away from a Bank of England decision. Going into that euro-dollar, 106.13. I'm going to get to a Goldman call on crude a little bit later, but right now, WTI, $77.60, up by 0.4%. If you're looking for economic data, disappointing economic data out of China. Business and consumer activity slumping to their weakest levels since the Shanghai lockdown back in spring. More disruption expected as the country exit COVID-0, with one study predicting, listen to this, Tom, nearly 1 million people could die from COVID-19. Now, we had some big estimates in this country that didn't materialize. We saw some big estimates in many places that did not materialize. But there's a real concern about how this COVID story plays out in China as they reopen, Tom, and this virus rips.
Their science, or almost pseudoscience, is very different. And part of that, John, is the demographics. I think I can't say enough about the age flip here, where America said, get the old people first, and essentially China did the opposite. And there's a lot of exposure of people that could have really difficult time.
I think we've all struggled with that over the last 12 months or so. Lisa, you've talked about it as well, how we've got an autocratic country who hasn't been able to mandate the vaccine in the way that you'd think they would.
And now they're having to do a public relations campaign to try to get people to believe that it's safe and effective for older people. How much do they actually care about how many people die and get sick, and how much do they care more about the economic activity that's creating a very unfavorable situation for them heading into 2023?
We're going to pause and go to one of our great China watchers. He is in London, Tom McKenzie, on duty in Beijing for many, many years. And Tom, I want to rip up the script here to John's point, which is just simply Beijing, Xi, in this shift in COVID policy. You have lived, the red doors in China and all of the drama there and such. Who is dictating this change in science in China?
Well, ultimately, it will be Xi Jinping. But you're right to point out that this is a radical shift. This is a leader, a president, the party secretary who tied his own reputation to the COVID zero policy over the last 3 years that he described as being morally superior to the system, to the response of the United States. But you don't get a U-turn like this in China without ultimately the sign-off of Xi Jinping. And I think for the business community, it's also a reminder that the argument by many China watchers is that you now have a body politic in China, led again by Xi Jinping, that is firmly focused on ideology rather than pragmatic policymaking. The kind of pragmatic policymaking we saw and were accustomed to of the past. If you hadn't believed that shift when they started putting party sales into private businesses 5 years ago, when they started cracking down on technology a couple of years ago, and now around COVID zero, built on nationalism that blocked the entry of mRNA vaccines, then you need to wake up, would be the argument of some who push for that.
Tom, in Beijing, when you were there, there's the Peking Union Medical College Hospital, just as one example of first-rate, world-class medical care. Okay, that's for fancy people like you. When you get away from that to the rest of China, do they have the infrastructure to do this science now that they're going towards a more Western policy?
On any given day pre-pandemic, Tom, a Chinese hospital is an intensely stressful place to be, away from Peking United's stellar hospital in the central of the capital. People have to pay for their own medicines. They have a level of insurance, but you turn up at a hospital, you have to get a ticket, you have to be checked numerous different times. It is a packed, crowded, chaotic place, pre-pandemic. Do they have the facilities in place to cope with the spread of Omicron? At this point, no. And again, an open goal for the Chinese authorities, 3 years to prepare for this. They did effectively keep the death rate well below what you saw in the US, well below what you saw here in the UK. But what they didn't do is prepare the medical facilities for this eventual opening up. And again, you've talked about the failures to vaccinate the elderly population because they were concerned about a backlash amongst the elderly. There's a big mix as well. You had state media, policymakers also pushing TCM, traditional Chinese medicine sources, and you have the deep-seated skepticism after decades of health issues and scandals around medicines and drugs and vaccines in China. The elderly population were resistant, and now they have to be persuaded.
All this leaves one wondering, why now? Why in this way? Why such a sudden move to open up without a more concerted effort to vaccinate individuals? Is this a health situation, or is this completely being driven by the business outlook right now in China, and really it harkens to a commitment to get growth back up to a 4 or 5% level?
Frankly, it's very difficult to know exactly what led up to the decision to pull such a significant U-turn. There was estimates, of course, there were estimates, or there was an expectation that post-party Congress you would get some kind of shift. Very few people I know who watch China closely expected a shift that is this dramatic. Was it a result of the protests? Was it a result of the economic deterioration, as you say? What we haven't heard is senior officials within the Politburo Standing Committee, including Xi Jinping and others, who have come out and given voice to this shift. That leads to continued uncertainty. Do you want to invest as a business in this environment if the senior leadership haven't come out and articulated their conviction that this policy U-turn is what is needed? Until that happens, arguably, those investment flows aren't going to tick up. And the data, yes, backward-looking though it was, is pretty remarkable when you see a 6% drop, for example, in retail sales. And that has all sorts of consequences for European companies based here that have exposure to China. And then, don't forget, the unemployment ticked up as well. You have 20% unemployment amongst China's youth. That is a huge challenge for this government.
How long, with the people who you speak with, how long will it take before business activity increases, given that as infections start to spread, people are going to start being more cautious just to prevent their own getting sick?
I mean, to that point, Goldman Sachs, right, downgrading their growth forecasts to a little over 2% for this year for China's GDP, but ramping it up for next year, a little over 5%, because they expect that you will get out of this. But the here and now is, when I speak to people on the ground, 80% roughly of my contacts on the ground now say they have the virus. For the context, in the last 3 years, you would be hard pushed to find anyone in China who knew anyone who had caught the virus. That has radically changed just in the last few weeks. Businesses are struggling. The city center of Beijing is essentially empty. I spoke to a business leader an hour ago. He described it as chaotic. 80% of his staff are infected. So the here and now is, it is a struggle. You're hearing of trading desks in Shanghai that can't be manned. You're hearing of factories where they're running short on staff because the virus is rapidly ripping through that population. They'll get through this, of course. The economy will pick up at some point, but as Nomura says, it's going to be a bumpy and painful ride.
Tom McKenzie, thank you, sir, of Bloomberg out of London. On China, I heard even trading volumes were rolling over. I spoke to David Sasser about that, of Bloomberg Intelligence. Even trading volumes are rolling over because so many people are getting COVID. They're not staffing the trading floor.
Yeah, it's not funny. And
it's really not.
What I would say is not only is it the illness of it, Omicron and all that we've gone through, but, I just think it's this whole, I'm speaking as a complete amateur, John, this long COVID thing and some of the ramifications, frankly, that you've recently felt yourself personally.
We're still learning about it, and I think we'll continue to learn about it going into another year of this, into 2023. I promised you that call from Goldman, so allow me to share it with you. Jeff Curry and the team over at Goldman Sachs looking for triple-digit crude again by the end of 2023, and it's all about CapEx or the lack thereof. Here's the quote. Lisa, despite a near doubling year-on-year of many commodity prices, by May 22, CapEx across the entire commodity complex disappointed, and that is the key issue for Jeff Curry and his team.
And that's what JP Morgan is saying too, that what we have seen is not an eradication of the super cycle they were talking about, but a doubling down, showing just how much people are not investing in a space that many people think will be more obsolete in 10 or 20 years. And that's just going to fuel this incredible price rise. Again, how does that filter into inflation, considering how much gasoline prices, how much oil prices have fallen this year?
Question of the day of the last 24 hours from Bob Michael at JP Morgan Asset Management. Is the recent disinflation transitory? Get your head around that.
That's an original word. Bob Michael, new territory there.
Isn't Bob great?
New language territory.
Disinflation.
From New York City, this is Bloomberg.
ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Equities yesterday on the S&P down about 0.6%. The moves are bigger this morning, believe it or not. Equity futures look like this. On the S&P 500, we're down by almost 1 full percentage point. On the Nasdaq, we're down about 1.28%. In the bond market on twos yesterday, the 2-year totally unchanged on the session.
Yeah.
After everything we heard from Chairman Powell, the 2-year went absolutely nowhere at the close, Tom. This morning it's up by 2 or 3 basis points back to 423.
And the VIX is the same thing, and it goes back again to these headlines that we're seeing from the sell side here on the market view. Forward, I think it's okay to have a non-news. I mean, don't you think they're sort of happy at the Eccles building this morning?
No.
They got through it and...
No, I don't think they're happy.
Why are they not happy?
Because the market is not buying what they're selling. They just put out their average projection, their median forecast for Fed funds at the end of next year at 5.1%. Right now, the peak Fed funds rate being priced into the market is 4.89%. That is in May, and then it comes down. Then you see rate cuts. That is not what they want to see.
Just to be clear, and what we're pricing is right below the bottom dot.
But that's my point. Yes, exactly.
So
Thank you.
This Fed
so the market, I did not know this. We're pricing below the bottom dot.
At the end of 23,
but
this market's not buying it.
The market is not buying what they're selling. This is a lack of credibility or just a complete exhaustion right now of everybody who just wants to go home.
I'm sure we had the same conversation yesterday, Tommy.
I can't remember, John. I can't remember. The accommodation right now is a negative 0.527, which is not where Powell wants it.
I'm going to finish on foreign exchange just briefly. A little bit later this morning, top of the hour, 30 minutes away, we'll get a Bank of England decision. In the next hour after that, you'll hear from the ECB. Right now, looking at both euro dollar and sterling. Euro dollar shaping up as follows. The euro has come back from about 95.36 to 106 right now. So that's a big change for euro dollar. Sterling looks a little something like this. Cable 123.41. The lows of the year on cable, Tom, we've gone from 103.50 intraday at the back end of September to 123.41.
Strong sterling. I'm going to go to political stability with Sunak. My amateur take across 6 newspapers, including Bloomberg.com UK, is, as you said, John, he's provided stability after, I mean, come on, we came off, I'll let you describe it. I mean, the Trussian era.
Is that what you're calling it?
Yeah, it's like the Scaramucci era, but it's a little longer.
Well, I imagine we'll be writing books about it, that's for sure.
But there is stability, which is a good feeling amid the agony of their utility crisis.
There is a little bit more, relatively speaking, policy stability, but at a very, very difficult time. I said that Bank of England decision is about 30 minutes away. The Bank of England expected to slow the pace of tightening with inflation easing from a 41-year high. Recent voting patterns suggest any decision is likely to be unanimous. Governor Andrew Bailey weighing in a little bit earlier this week.
On radio, you should see this.